Hello, everyone, and welcome to our second live virtual event. This is Roger Michalski of Eagle Financial Publications, and we're thrilled to have you with us today. As I said, this is our second time we've done this on our YouTube channel, and we had so much great feedback the first time, and so we decided to do it again. And this time we've had 3 times as many people sign up to watch this as we did the first time. So it's an exciting event. We're so excited about all the great feedback we've had on it. So I'm sure we'll be doing it again. So today we're going to talk about the top 6 picks for 2023. And I want to remind you before we get into that, if you haven't subscribed to our Eagle Investing Network YouTube channel, you can do that by clicking the button right below this video right now. And that way you won't miss any of our great free content that we put up every week. And of course, these live virtual events. We'll have a bunch of individual presentations today. We're going to start with the panel of everybody you see on the screen here. We got Bryan Perry, John Johnson, Jim Woods, Mark Skousen, and Bob Carlson. And we'll also they'll each have a presentation today where they'll be giving you their number 1 pick for the year. And we also have a couple new people to Eagle that are not on this panel, but they're going to be making a presentation a little bit later. So I'll tell you about that a little bit later. So first, we're going to talk about the best sectors for 2023. First thing, and I appreciate all the people. We had great feedback on doing a couple of our poll questions beforehand. And our first poll question that we're going to launch with this. Our first poll question was, how will the market perform in 2023? And here's how our customers and our viewers responded. We'll go around the table here and get everybody's opinion. So 41%, this was a pretty big victory. 41% said we will be up single digits this year. 22% said we'll be break even. 18% said we'll be up double digits. So most people are pretty positive because if you're doing the math in your head, we don't have that much left. So 13% said we'll be down single digits and only 6% said we'll be down double digits. So up single digits by far the biggest at 41, but really break even or positive, people don't think the market's going to go down that much. So I know everybody's screen is probably a little bit different, but I'm just going to go around the screen that I see them. So Bryan, we'll start with you. Bryan, what do you think?
Okay. Yeah,
it's going to be?
Interesting results there, Roger. I personally think the market's going to do a hockey stick move higher here. We're going to go sideways, chop around here. There's a lot of uncertainty, a lot of moving parts right now with with interest rates, with the Fed. We're going to probably see some trough earnings here that are going to be reflected in the fourth quarter and the first quarter. So it's the market's forward looking, and I think that we're going to see a hockey stick move in the second half of the year that'll probably start in late spring. That'll take the market S&P higher by at least 20% is what I'm looking for.
All right, very bullish. Okay, John, we'll go to you next.
I'm kind of a half and half guy. I'm a first half, second half. I think we still have lows to make on the bear market, maybe not in all the indices, but in some of them. And I think that's going to work to flush out the system. This bear market, if it goes through the first half or a good chunk of it, it'll have run its course as a traditional bear market would run. And, we should work through a lot of our issues at that point. There's still some lingering stuff out there from the pandemic, but we'll be through a lot of that. And we'll be able to, I'm kind of the same way, second half, that's my second half. It's going to be a lot better. Now, what it's going to do overall, since I still think we have quite a bit to go down, I think we'll go up significantly in the second half. But if you look at where we go through the first half, I think it might be kind of a wash, but we play what we got. And if the market rallies late, we're going to end up really good. It's going to be a good market late year. And we'll be looking back going, wow, what a great year this turned out to be.
All right, Bob, you're next.
Yeah, mine's similar to John's. I think it's probably going to end the year down single digits, but it's going to be quite a journey along the way. I think right now, investors are too optimistic about earnings. I think economy is going to slow down and earnings are going to come down more than people expect. And once that comes true, that's going to bring stock prices down first half, maybe the first 3 quarters of the year. But then at some point, the Fed's gonna stop tightening and eventually switch to an easing policy. And then markets will start going up probably later in the year. So like John said, more downward to go, but light at the end of the tunnel near the end of the year, and a good surge upward towards the end of the year.
All right, Mark, you're next. We got a pretty strong so far. The first half of the year not looking so good. What do you think, Mark?
So if the Federal Reserve just went on vacation for a year, the market would go higher. I think you have gridlock in Washington, barely, thank goodness for that. I think the market's like gridlock. So we're not going to have any major change on the fiscal side, except if Joe Biden decides to use his executive orders to do more crazy things. The Fed is the big elephant in the room, obviously, but if they didn't do anything, I think the market is definitely headed higher because you've already had a significant bear market, especially in technology stocks. And I think that's what the hope is. I agree with the psychology. You'll notice the investors are still upbeat. They're optimistic. Any positive sign out there, the market rallies. And that's a sign, that's a good sign. So that means to me, if the Fed pivots in any way, the market is going to head higher. And we're going to see some positive news there. But the Fed is notorious for overreacting. During the pandemic, what did they do? They increased the money supply 40%. They cut interest rates even lower to zero. The zero interest rate policy continued during the pandemic. And then suddenly, surprise, surprise, as a result of their policies, which they won't willingly admit, now they say, oh, we have an inflation problem. Oh, God, we thought this was never going to happen. And it now has happened. And it's just a disaster time. I call it the Fed disaster plan. First, we had the Biden disaster plan, followed by the Fed disaster plan. And the money supply stopped growing entirely. So it was growing at 40%. Now it's down to nothing. They've raised interest rates significantly. And so my prediction is that sometime in 2023, and this is a big if the Fed keeps pushing and channeling Paul Volcker, which is what Jay Powell has been doing, channeling Paul Volcker. He thinks he can be the next Paul Volcker and he can kill inflation really fast. I think there's going to be some kind of a crisis in the first half of the year, and that's going to force the Fed to reverse itself and to pivot and to say, oh my gosh, we overreacted. And then you're going to see a sharp rally, the hockey stick that Bryan was talking about. So I think we're going to end the year higher, substantially higher, but it has to be after this crisis occurs that forces the Fed, because they're not going to do it on their own. You can tell every time Jay Powell speaks, he's determined, absolutely determined to kill this inflation because he doesn't want to go down in history as the man who couldn't. He had this inflation problem and he didn't solve it. So he has a lot more gumption than I realized. I thought he was really a weak Fed chairman when he was appointed, but he's showing his that he really means business. And you notice the market rallies, and then he speaks, and then the market tanks. So that's my general view.
All right. Well, we're going to talk more about the Fed right after Jim gives his prediction for the year.
Well, the first fortnight so far in 2023 is kind of, I think, indicative of what this market's mood is and going forward, what it'll be, because we saw a big optimistic run higher the first 7-8 days. And the last couple of days, we've seen a pullback. And for the same worries that all of us have just brought up, the Fed situation, inflation, earnings, there's going to be, the market's now looking at economic growth more than it is almost interest rates. And the last couple of days, we've seen some very downbeat growth numbers, PPI. So you're starting to see the market you're starting to see the results of the Fed's policy over the last year, and I think that's going to continue. However, I actually agree with Bryan in the sense that the market wants to go higher. I think if the Fed starts to see that it's run its course, like Mark said, it may make a mistake and it may pivot. Even if it doesn't pivot, even if it just stops hiking rates at that 5% Fed funds, like so-called terminal rate, that is going to be a very big positive, because as Mark said, the investors are bullish. They're sick of seeing the stock market go down. They want to put money to work, and they want to put money to work in the stuff that has been beaten down the most over the past year. And we'll get to that, I know, in the sector discussion, but I think that we're going to kind of bounce around for the next several months. But once the Fed is for sure done, which may be March, hopefully, like Bryan said, in the spring, then you're going to start to see stocks go up significantly. I'm bullish. I think it's going to be, I'm with that 18% that says double digits at the end of the year. And I think that most of that is going to come in the second half of the year. So we'll have all the negatives will be baked in. And I think that's when the market will start to really come back and grow, and the economy will start to grow again as well. So I'm as bullish as I can be right now.
Okay, well, let's talk a little bit, dig a little deeper into this, the Fed and what is he going to do? And I'll just we don't need to go around the circle because some of you talked a little bit about it, but what do you think the Fed is going to do? How much is it going to be? A quarter point? Is it going to be a half point the next time? Is it going to be the first half of the year he's still going to be raising, and then is it going to stop? I don't think he's going to cut, but let's throw that out there. Will they cut at some point this year, or will they just stop? And anybody who wants to chime in.
Well, Fed fund futures right now are calling for a 25 basis point hike on the 1st of February, and then again at the end of March, another 25 basis points. That's what the smart money's betting on. However, if you look at last year, every time the smart money bet on the Fed getting a little bit more dovish, as Mark said earlier, Powell came in and just crushed their dreams. Mm-hmm. So that if that happens again, then the markets are going to suffer, because it's like the Lucy with the football thing. Powell has been lifting that football out every time, and but I mean, how many more times is he going to do that? At some point he's going to have to let Charlie Brown kick the ball, but we'll see.
The other thing that's really important here that we've been talking about the price of money, but it's also the supply of money, which, by the way, the Fed completely ignores. They don't even look at money supply figures anymore. Jay Powell actually said that Milton Friedman his monetary policy is irrelevant today. So the guy has no sense of history. But the money supply has stopped growing completely, and that needs to also turn around. That needs to pivot if you're going to have any kind of relaxation in the marketplace. By the way, there's another big issue here that is short term, and that is the debt ceiling debate in the House. So this is one area where gridlock is going to be an interesting play there. And now, traditionally, it hasn't really hurt the market that much. It just depends. It's kind of a short-term problem, and it gets resolved because nobody wants the government, except for us, to stop performing. It'd be great. Those new 87,000 IRS agents were laid off permanently.
Anybody else want to chime in?
As far as the Fed, it's going to do what it does. I think that was the reference earlier. And, a lot of the Fed governors, whether they're bolstering or not, are just blustering, we're going to break something and that type of thing. The Fed usually does break things. Mark's right. It's going to come in and it will go too far, and it'll precipitate more of the problems we have here. But we do have other problems on the side of the Fed. I mean, the market's still led around by every notion that, economic data is weaker, so the Fed's going to be easier on us, and so we'll go up today. But we're getting more, like Jim said, a reality setting in where, gosh, things aren't really that good. We got really bad credit situation. All the banks reported they've all upped their loss provisions. Never a good thing. They know what's going on. Goldman said they're having more defaults. We have all these trillions in forced savings out there that they keep referring to. And yet Goldman is noting that they're having more and more defaults and delinquencies on their credit cards and all their revolving debt. So there's going to be issues here that I think the Fed is just too focused on, like this 180,000 new claims today. I mean, I don't know where they're pulling these numbers out of, who's doing what to them, what they're saying over them before they release them. But I talk to a lot of businesses. A lot of them need workers. A lot of them are laying off workers. And that goes in my first half, second half. Everything's halves now. Half the economy is performing well, half the economy's not. And the Fed's focused on the part that is performing well. And I think it could easily break the other half inadvertently just by being the Fed. And that's a big concern for me.
Yeah, it sure seems like, they're just pretty much hell bent on putting 6 to 10 million people out of work. And it's, following the Phillips curve is they're kind of camped out in this area where most of inflation was caused by commodities. And Alan Blinder, former vice chairman of the Fed, and he's an economics professor at Princeton, give a very, very powerful argument as to the trend of inflation right now is running around 2.4%. We're all addicted to year over year comparisons, but if in the last 6 months we've seen declining inflation come down rather handily, and it's interesting how this this latest read on PPI, and yesterday it looked like the market was going to rally because we got soft data, but then the markets had a little moment here because it is reflective of the fact that, hey, personal savings are down to a very low rate now, less than 2.5%, which is well below the 7% average, and credit card debt's at record highs nearing $1 trillion. So it's with your average credit card interest rate up to 19%. So Americans are very resilient. They can move through this pretty swiftly from the standpoint of if interest rates start coming back down. And the 30-year bond is already saying that. The 10-year bond is already back down to 3.3. You got six-month bills at 4.8. So the bond market is already telegraphing that the Fed should pause. And they're kind of ignoring what they don't run the bond market. The bond market runs the Fed in the bigger game of life. And it just seems like they are very myopic here, and they're going to get their quarter point in the next meeting here, next 7 days or 10 days. And I think maybe March is a pause if we get a 7th month of declining inflation that's as material as what we saw in the last month here, especially in retail sales. That was just a real very low number from the standpoint. And I think that's going to show up in January as well. It seems like discretionary spending is just kind of grinding to a halt.
Yeah, there's an early what's going on is I'm sure that Powell and the others are saying, hey, we're starting to look like we are making our impact and this is positive, but it's too early to act. You've just begun this trend. So I think that's why they're going to raise rates by another quarter point. I would like to point out a very positive sign that that the big corporations learned from the 2008-2009 financial crisis, and that is to have plenty of cash on hand. And I'll tell you, if you look at Amazon and Microsoft and Apple and Facebook and so on, and Berkshire Hathaway, all of these big companies, they have huge cash positions. This is a very positive sign compared to 2008-09, where they were left with their shorts down. And so that's one reason I think that when you do see a pivot, the market will turn around very quickly. It'll be a very positive sign because I think big corporations are in much better shape cash-wise than they have been in the past.
I'd just like to say too, as Bryan was talking about the bond market, it seems to be screaming and no one's listening. I haven't heard on any of the financial stations anyone talk about the yield curves lately. And the 3-month 10-year is just frighteningly inverted. And I can't understand how apparently that has no impact on Powell and the Fed. They're going to keep pushing on this. But if there's anything yelling, it's the bond market. It's yelling loud right now.
A negative 80 something on the
Pips, yeah.
tens twos is just
Yeah.
that's a record. That's never been.
Yeah, it's mind numbing.
Yeah.
To Bob,
That can swing.
on the Fed.
Good argument for bonds
but Bob's a
later.
little more like he's a little more, stays in the background. So I got to make sure he gets his chance to get in with all you other guys. So your thoughts on the Fed, Bob?
Well, the Fed has something like 800 PhDs in economics on its staff, and yet somehow it gets the turning points wrong all the time, and short-term predictions are always wrong. So I'm anticipating it's going to over tighten. It over loosened the last few years. It's going to over tighten, and I don't think it's going to ease as soon as the market's expecting. So I think there's going to be a economic downturn. Rates are going to probably pop up from where they are here at some point. And then sometime later in the year, the Fed will realize it overdid things, and then we'll start reversing.
Well, they need America's economist, Mark Skousen, on the staff, and we wouldn't have that problem.
And a couple bankers too.
Unfortunately, I'm not in charge of the Fed. But if I were, I would resign right away, and we would.
We need a couple of little small businessmen on there. That's it.
Okay,
Powell is actually not an economist. That's I guess I think a positive thing actually.
It's refreshing to.
Well, Alan Greenspan, he was not an economist either. These were Wall Street people. Ben Bernanke was an economist, and he oversaw the worst financial crisis. And a lot of people give him high marks. I don't. But you actually do want a Wall Street person on there. But Alan Greenspan was probably pretty good. And Paul Volcker was a Wall Street guy.
Yeah.
All right. So before we get into the sectors, let's just touch a little bit on inflation, because that's what's on everybody's mind, and obviously, falls into what we've been talking about. But can inflation come down? I mean, Bryan talked about it is starting to come down, but how long will it take to get down to even 5% year over year, or as Bryan said, should we really not be looking year over year and be looking at the month to month?
Well, Hayek said inflation's a tiger by the tail. Once it gets out, it's really hard to control. And one of the things that has not been discussed here is the amount of money still being pumped into the system. And we're having these record deficits going on. This is why you have the raising of the debt ceiling for the 10th time in just a couple of years. And look at Social Security payments. That's 75 million people are getting 8.9% increase. I mean, that's kind of inflationary, if you ask me. Mm-hmm. And anybody involved with public works, they're all unionized. They automatically get a CPI rise of 8 to 9%. I mean, there's a lot of new money coming into the system chasing maybe not that many goods. And so this inflation problem may not be solved yet. It does look good right now, but it could be still a problem.
We're paying people not to produce, not to work as much, and we're demanding those that are to create more. Well, that's a scenario you're getting it from both ends there, because I mean, the business I have, we aren't seeing prices go down enough to really make a difference right now. And it's the commodities, as Bryan was saying, they're still up, and some of them are already turning back up, which is really frightening.
Yeah, copper prices are going back up again. That's a big deal. Of course, that's because China's opening up.
That's a two-edged situation there. China is reopening, and that will soften, a recessionary blow, because you do have a big counter lever there. And from what I'm reading, supply chains have really loosened up. I mean, I think there's a lot of positive things happening in the supply chain, which was, part and parcel to the whole inflation equation here. So commodities, that's going to be, that's going to ebb and flow with a lot of things out there. The war is still going to go on here for the next 6 months or thereabouts, probably, until that something culminates there. And that's still going to keep pressure on soft commodities. But again, it's in wages, there was these big COLA increases that Mark just spoke of. Those are huge. And they might have caught that pay raise right at the top, peak inflation. So You know, and that's going to provide maybe some little bit better spending power for the retirees. That's the highest increase I think since 1981, going way back when it was like a 14% increase. So it's the labor market is still where you don't put that back in the bottle. When wages are up, they're up. You know, hourly wages, and but people are paying less for bonuses and less for hiring bonuses now than they were about 6-7 months ago for new jobs.
I'm gonna borrow a phrase from the esteemed Mark Skousen and say it's kind of a Viennese waltz between the tailwinds of lower inflation and also the tailwind of the China reopening, because that is a huge thing. I think people maybe not are not as aware of that whole China thing is going to create more global growth, and it's going to help the supply chain issues. But then again,
you're
got
bullish
slower
on Chinese
growth.
stocks now, I hear.
Yes, I am. I'm bullish on. I asked the question yesterday on my alert whether it was a good idea right now to buy Chinese stocks, and I think if you're looking at a relative valuation situation, certainly there's some opportunity there. I mean, the Chinese stock market has been down over the last 5 years, like 40%, and the S&P's been up about 40%. So that's an 80% differential between domestic versus Chinese stocks. So where do you think the most gains are going to come, relatively speaking, over the next year or so? It seems to me like China's a good place to start looking around.
Well, that might be
probabilities look a lot better.
Yeah.
All right. Well, let's get into the sectors next. And we didn't have this as one of our on our poll. We didn't have China as one of the answers, but that might be Jim's answer. So we asked the poll question to our viewers. The viewers said, what will be the best performing sector in 2023? 46% said energy. 18% said technology. That was the next highest. So there's a huge difference. 46% energy, 18% technology, 14% gold and precious metals, 13% said bonds, and 9% said healthcare. So let's go in reverse order this time. So Jim, what do you think will be the best performing sector in 2023? And did you just give the answer away just a couple of minutes
well,
ago?
I'm not prepared at this moment to say that Chinese stocks are going to be the best performing sector. I do think that they will outperform domestic stocks in this year because of the aforementioned reasons, the reopening, and also they're one of the few countries that's actually pumping more money into there to try to stimulate the economy after a horrendous decision to have the zero COVID policy for the last year and a half or so. It was just one of the worst decisions ever, and they're so entrenched in proving that they're right that they finally admitted they weren't, and although they didn't technically admit it, but they switched policy. So when you switch policy, you think maybe they realized that they were doing things wrong. But with the energy situation, it's not that I'm bearish on that sector. However, I do not think it will be the best performing sector again, because by far it was the best performing sector last year, and money is going to rotate into relative valuations. What was the worst performing sector last year? Technology and communications. What do I think is going to do well this year relatively? Technology and communications. And that'll happen in the back half, because if we get that situation, now this is a big if, of course, if we get that situation where inflation tames, growth doesn't go down too bad, and earnings are, decent, you're going to see people take on more risk. And where do you take on the most risk? High beta technology stocks. So I'm more bullish, and I'll be looking in that sector for the big breakout stocks to own, because those are the ones that are going to be fueled by the strong relative price strength over the next, say, 6 months to 8 months, year maybe. So I like technology. That would be my vote as the best sector. But Chinese stocks also a place to look as well.
So Jim gives us a bonus pick. All right. He
Over
always
deliver, Roger.
always over delivers. That's right. All right, Mark, you're next. What sector do you think will be the best this year?
Well, one of the lines from the maxims from Wall Street is from the voice to the foist, which is Brooklyn's our a little bit of New York accent there. And I think one of the areas, I'm really impressed out of the box this year of the commodity sector. Boy, look at what has happened to copper stocks, gold and silver stocks. They're up by double digits already. And is that a false start? Well, they've had plenty of false starts, so that's possible. But I do think this whole infrastructure market is just a very exciting area. And I have several recommendations in my newsletter on the infrastructure play. And if we are going to move to EVs, and I noticed despite all the problems with electronic vehicles and Tesla, and during the freezing cold period, you had EVs not performing well. I noticed the car ads, they're still promoting pretty heavily the new BMW, the Mercedes-Benz, electric cars. So they think there's a lot of demand out there for them. Tesla is making a bit of a recovery. But look at copper, lithium, even silver, all of these, gold, they're all part of this, aluminum. This is really a bullish sector, in my opinion. I think energy in general is a good conservative play for this year. No question about that. And if John's right that we're going to have lows in the stock market, energy stocks going to still, I think, be a decent performer in that kind of environment, just like they were in 2022. So just because energy stocks are the best performing last year, it doesn't mean that trend can't continue into this year. And in fact, my energy stocks are up pretty nicely so far in January. So, but of course, everything else is up too. So it's all relative.
Yeah. So EVs, you're talking about EVs. 10% of automobile sales in America last year were EVs, which was the highest it's ever been. Still nowhere near where it is internationally, but it's definitely starting to get up there. And you're right, they're really pushing EVs. GM says they're not going to have anything but EV cars come 2035. It's only 12 years away. I don't believe that.
That is because of that stupid. I live in California, and that's because of the stupid rule by Newsom, who we call nuisance, Governor Nuisance, pushing through. Let me tell you, the hybrids are a much better vehicle, and they're much more dependable.
Yeah, I don't understand why.
That's the way to go instead of pushing these pure EV cars, and you have to have your car towed when you run out of electricity.
All right, I totally agree, but that's going to get us on a whole nother subject. So let's go over to Bob and talk about. So Bob, what sector do you think will be best this year?
Yeah, I'll give you two. One that's on a list are bonds. As I said earlier, I think interest rates are going to move back up the next few months, but sometime in the second half of the year would be a good time to buy bonds. They had a terrible 2022 as their worst year ever by a lot of measures, and I think that's going to reverse course sometime in 2023. The other sector I'd look at, it's not exactly a sector, but value stocks. Value stocks underperform growth stocks by historic margins over the last, I think it's 17 years. They started to come around, outperformed growth late in 2022. And I think that's going to continue for a significant part of time. I think we've reached that turn in that cycle finally where we switched from a growth bias in the stock market to a value bias. So I think value stocks, value stock funds, anything with that kind of theme is going to do better than the market indexes in 2023 and beyond that.
All right. Well,
I'll add one thing to that, Bob, and the long-term Treasury bond total return in 2022 was almost down almost 30%.
Right.
That is the worst year on record. And it's the second worst year was 1980, when it was the Volcker situation, and we actually had that just a terrible year in bonds and stocks. So that's where value is going to be. That's another. I like that's my third bonus. Long-term treasury.
Not that we're counting, right?
Yeah, exactly. Got to keep track of these things, everyone.
I know you do. All right, well, let's go to our guy in Texas, John. Well, you're in Texas. It's got to be energy, right?
Well, I'm very interested in energy still. I just don't. I mean, they're drilling hand over fist still here, and that is some of a holdover. But I said last year, as energy stocks toward the end of the year, they went down in base, that they would be coming up this first half of the year. So I still like them a lot. I'm really fascinated about the dollar this year, and how it's going to tie to some of this, because the dollar remains the best shirt in the laundry right now. But what concerns me is Saudi Arabia starting to accept transactions in non-dollar denominated currencies, and how that's going to play out, where the strength of the dollar is going to be. It'll still be strong for quite some time. I'm not predicting a dollar crash or anything, but I think we're going to see some more relative valuations there. Ultimately, I think the dollar is going to fall into a basket with everything else, but that's down the road. But to me, it's going to be an interesting play on all the commodities and the precious metals and how they respond to that, as we see just who becomes dominant. But that, as I said, that's down the road, and I'm much more short term than that. But it just fascinates me, and I've learned not to let my fascinations get in the way of market trading. So back to reality. What's near term for me is I still like the precious metals. I still like energy. Again, I'm a first half, second half kind of person here. I still think they have room to go. They're looking really strong here. They're getting plenty of buying. There's been a lot of buying in sovereigns picking up gold lately, and China's been buying literal tons of it on some days. And they're going to try to make their play with their gold-backed currency. And that's given a little bid still, just like the China opening is going to give bid to a lot of things. It's keeping that going as well. So I'm energy and precious metals, but I see toward the second half of the year, it's going to switch over, and then we're going to go into whatever, I think it was Jim, or whoever said earlier, whatever's been roughed up pretty good, that it's going to make money, is going to see that shift of funds that way. And we're going to see those patterns develop, just as we did coming out of 2009, just as we did coming out of 2000. Those 2001, those patterns will develop, and they'll be telling us that the money is shifting. And then we're going to see, I think, some growth areas take off. But I'm just not 100% that it's always just going to be default tech, because I do see that there are the old school hard stuff stocks that just I still foresee them being in high demand, their products in high demand. So it'd be a really broad group of stocks that we could be buying in the second half of the year still. That'd be really interesting.
Okay, great. All right, Bryan, what's your favorite sector for the year?
I'm kind of torn between two sectors here. The first certainly is I'm looking at subsectors within sectors here. One is the oil services area in the energy sector itself. The International Energy Administration came out yesterday forecasting the highest demand for oil in 2023. It's going to be over 102 million barrels per day. And this is basically being fueled by the China reopening, demand from China. So in this area here, a lot of the big names, the big E&P and, integrated oil companies have made just really great moves. But the earnings look like the best year-over-year earnings increases look like they're going to come from the oil services companies there. And, the two obvious big names in there, Halliburton and Schlumberger. And also Noble. I like Noble Energy, also, which is a big driller. And so you're seeing 40 to 80% year-over-year forecasts for earnings increases. And those charts are beautiful. So, you got to still let the technicals do the talking also. in this kind of a market where the primary trend is still lower. We fail at 39.75, the S&P. So there's some, it's I call it, stock by stock, block by block, and it's just everything has to stand on its own, especially. But with the reopening of China, I think that and it's also nice to be in what we call the arms dealer business. You're just not betting on one particular oil company, but you're servicing the sector itself. And this is kind of what the oil services companies are very good at. They spread their risk, and their services are global. The other one is interesting. Is another within the tech sector. I think a lot of the big mega caps are still going to have a lot of fits and starts, getting back up to where they were. But within the semiconductor area, I like the semiconductors because there's some major things happening that are really secular trends here. Certainly, Internet of Things, smart homes and smart buildings and smart offices. The business of working remote is just now it's embedded in society around the world. Things like autos and 5G, data centers. The business of analog still is everything that we have just about, and gaming is still huge around the world, as well as the business of building out plants and the onshoring now of semiconductor manufacturing here back in the U.S. So I like the semiconductor equipment companies, but another major technological advancement that's going here is called silicon carbide, and silicon carbide is it's a new compound that was kind of nascent a couple 3 years ago, but now it's becoming more essential because for just in the EV business, when you're making EVs, it's 10 times more powerful than the usual silicon chip. Okay, so it allows you to charge your car way faster and drive your car way longer, the distances. So these chips are in super high demand right now. And, there's Wolfspeed is building a plant out there. But the stock is kind of all over the place. But for those who want to look at, silicon carbide as the next big thing in the semiconductor space, then, onsemi is your biggest name. That's the leading name in that particular. And also ST Microelectronics, which is a Swiss company, STM. And both those stocks look great. They're above their 200-day moving averages and look like they want to trade. And so I've been trading those in my trading services in the past year. But now this silicon carbide is going to be a big theme, I think, for 2023. And again, second half technology should raise its head here. But we're already seeing some very good price action in some of these semiconductors, even during this very choppy time right now.
All right. Well, what a great panel this morning to get us going. I guess, well, depending on what coast you're on. It was actually the beginning of the afternoon for me, and but many of you on the West Coast, so it was in the morning. But regardless, we have a full day of presentations. Each one of these gentlemen will have their individual presentations throughout the day. We're going to have great specials on their products all day to kick off 2023. We're going to have these $23 specials. Can't go wrong with testing things out for only $23. Like two people going to Wendy's is going to cost you more than that right now. So look for our specials, and also on each one of these sessions, each one of these guys will be giving you their number one pick for the year. So a lot of great stuff to look forward to the rest of the day. I look forward to spending the next several hours with everybody out there, and want to remind you to subscribe to our YouTube channel, the Eagle Investing Network. Hit the subscribe button now right below this video. That way you don't miss any of these live events or the weekly content we put up there. Lots of great free content. So make sure you subscribe now. And thank you, gentlemen, for spending the day with our viewers. And we'll be back in just a couple of minutes with Mark Skousen. Thank you.
Thank you.
Welcome back, everybody. I hope you enjoyed our panel presentation. It's always a very great live event and lots of back and forth. So I hope you really enjoyed that. I want to remind everybody, if you'd like to get information every Wednesday, we have new videos on our YouTube channel. Hit the subscribe button right below this video, and you'll be subscribed to our YouTube channel, and you'll get lots of great free content every single week. Our next presenter, as you see on the screen with me, is Mark Skousen, and he's going to talk about my #1 energy stock for 2023. Mark, how you doing today?
Doing really well. As you can see, I'm dressed for the new year, a little bit of a tuxedo, red, my little bit of balloons to represent the new year. It's a very exciting time period to enter, and this is supposed to be the year where the stock market recovers. We're just wondering when, and while we're waiting, we're doing actually very well so far with our investments. So I'm pretty happy about where we're headed.
All right, well, let's get into the presentation. I'm going to share my screen here. All right, Mark, you see the presentation?
Yep.
All right.
Yeah, there's a picture of, whoops.
I just went to the wrong thing.
Yeah, there we go.
I just need to hit a slideshow from the beginning. There we go.
Yeah.
All right.
Yeah.
There we go. So Mark, take it away.
Yeah, thank you, Roger. This is a picture of me a few years ago in front of the famous bull and bear sculpture. And it is always a struggle, isn't it, about where we're headed now. Traditionally, as you know, I tend to be a bull because historically, 2 out of 3 days, the stock market is up. Now, 2022 was one of those occasions where every 7 or 8 years, every 10 years, there's a bear market, and we've been going through that in 2022, and as we come into 2023, I see the opportunity here. We have a 20% position in cash right now in our own portfolio, and we use this to look for bargain opportunities. And bargains are developing in the stock market, and it's the best way to take advantage. I had a student come up to me. I teach at Chapman University out here in California, and I'm teaching a class called Puzzles and Paradoxes in Economics, and we found that I had a student come up to me and say, well, I'm thinking of shorting the market. And I said, well, the market's already gone through a major bear market. It's really tough to short the market. I think a better strategy is to build a cash position and looking for bargain opportunities, because when the market does turn around, it turns around very, very quickly. It's very difficult to find people who really are successful shorting the market. So I'm on a bullish side, and so I'm going to start off here with, this is a picture of me with Kevin O'Leary, Mr. Wonderful. He was a delight to work with. His persona is quite different than the aggressive, rather critical approach that he takes on Shark Tank. Here he is. I'm holding his book, and he's holding my book, Maxims of Wall Street. And one of the quotes I have for Kevin O'Leary in my new 10th edition of the Maxims of Wall Street is, getting rich is easy if you follow 3 rules: spend less, save more, and invest the difference. And we're going to focus in particular on investing the difference in our presentation today. Particularly dividend-paying stocks, to me, does make a big difference and gives you the edge. In fact, Jeremy Siegel, the Wizard of Wharton, says that dividend-paying stocks give you the edge, give investors the edge that they need to really beat the market, because during a bear market, it cushions the fall, and that's what's happened in 2022. In our portfolio, we have a lot of high dividend-paying stocks, and they did really nicely to cushion the fall, as they say, so you don't lose as much in the market. And then when it turns around, it leads the market. Dividend-paying stocks give you the advantage to beat the market during a bull market. So that's basically my strategy. Now, this is a good overall view of several things that comes from Jerry. This is the Jeremy Siegel, the famous Jeremy Siegel chart on which investments have done the best. Now, understand this is the U.S. market. This is not a global market, but in the U.S. market, we see that the stock market is in a long upward trend. That even the Great Depression, when the stock market fell dramatically, and it took 15 years to recover. It's a blip on this screen, isn't it? This screen starts in 1802, goes to the current period, and
right around there.
Yeah, look at that. It looks like just a small blip on the screen, and so that suggests American exceptionalism that we continue to do really well over the long term. Now, it's not automatic. It depends. We have to be a free enterprise capitalist system. And if the government becomes too bureaucratic, too regulatory, excessively high taxes, then we could run into trouble, and it could be the end of this long-term bull market. But it does tend to give us optimism. And stocks have outperformed bonds. It's outperformed T-bills, cash, gold. Gold is in our portfolio. We recommend it, especially the dividend-paying gold mining companies. But you definitely don't want to spend too much time in cash, because you can see it gradually loses its value. But the key success is in the stock market, and based on this long-term trend, the quote from J. Paul Getty in the Maxims of Wall Street is very applicable. The seasoned investor buys his stocks when they are priced low, holds them for the long full rise, and takes in between dips and slumps in their stride. And certainly we've had a slump in our technology stocks, in many of our financial stocks, but they're making a comeback. And when they do, if you dollar cost average and you hold them through thick and thin, and you add to the position when the market's down, boy, you can make a lot of money over the long term. And I like this quote from Adrian Day, page 198 from the Maxims of Wall Street. Good investing is simple. Buy a good asset at a good price and hold on for a good long time. I think this chart demonstrates that with almost every position here: stocks, bonds, bills, gold, except for the dollar. So it does
definitely
suggest,
sounds like Adrian. That's not, I can hear Adrian saying that.
Yeah, absolutely, that's for sure. Okay, so this is another really important chart here that demonstrates American exceptionalism. That's the red line here on this market. This was a study done by 3 economists covering 100 years of the stock market in the 20th century for 34 stock indexes around the world in 34 countries. And you'll notice the red line is the United States, and it outperformed the blue line, which is the world, or you could look at the world index without the US, and there's quite a substantial difference in terms of performance. So American exceptionalism, I think, is alive and well. This is a picture of me down here appearing in, I think it was 2017.
2018, yep.
2018, thank you. Roger's always here to make.
There it is.
That
was your
CNBC with Rick Santelli in 2018. I think it was in December. And you'll notice the caption below, the mother of all bull markets. And you may say, well, yeah, it was definitely a bull market. But you have to remember that there are doom and gloomers, perma bears, who are predicting a crash, a stock market crash during that entire bull market. And so I was there to defend the view that we're in the mother of all bull markets. And so I've had a big battle over the years with all the prophets of doom and gloom, especially in the 90s. I just did a report on that in the Skousen Cafe, how in 1985, I was on a panel with with the doom and gloomers, and they were predicting more inflation, higher interest rates, a bear market, if not a crash in 1985. And I was saying, I think things have turned, and we're going to experience a 30 to 40-year bull market in stocks and bonds, and the bears the gold bugs were proven wrong. So this chart seems to confirm what we were saying about the triumph of the optimists.
And that was pre-hat era, Mark Skousen.
That's right. I always wear a hat now because it represents economics. When you put your economics hat on, you can analyze the markets. My students at Chapman and other schools, they never remember my name, but they remember, the professor with the hat. So it's a nice feeling. Okay, so here's an example. This is an investment area that we still recommend, but as you can see, there have been periods of bear markets in technology. This is the most popular technology fund and or ETF. And as you can see, there have been bear markets in the past, and this one's lasted a lot longer, as you can tell. But really one that I think is very close to bottoming out. And so, there's an old expression, the worst become the foist, and using the Brooklyn accent, and the worst becomes the best performer. And so I think that's what's going to happen with the technology stocks. They were definitely overvalued. We all knew it. We just didn't know when they were going to lose value. But I always said to myself, these tech stocks could lose half their value and still be a little bit overvalued. And you had a 10-year period of easy money with interest rates at practically zero for 10 years. I mean, that is going to encourage a lot of speculation and creating of bubbles, financial bubbles, and those bubbles needed to be popped. And when the Fed raised the rates, they popped. But technology is a good long-term play because we still are the land of the free and the home of the brave, and we attract entrepreneurs from all over the world, and they can put together some great stories. So the Technology Select Fund XLK has their top holdings are Microsoft and Apple and Visa and NVIDIA, MasterCard. These are companies that have a great long-term future. So we're still in this fund. We're recommending it at this point because we think we're very close to a bottoming pattern, as you can see with the red line. And so that's one of our top recommendations. Now, the Ahren Growth Fund is in the same kind of situation. Here I am with my hat, meeting with Ron Ahren. Ron Ahren is a billionaire. He runs a mutual fund called the Ahren Funds. We meet annually for his meeting. This is me meeting with him in New York at the Opera House at Lincoln Center after one of his conferences. And we still recommend the Ahren Growth Fund, which he believes in investing in people, not businesses. So he's very focused on finding really good business managers. And of course, after the latest event in November, when I met with him, it had been 2 years since we'd been to the Ahren conference because of the lockdown. I asked Ron Ahren, I said, listen, since you focus so much on business management, you're picking managers who are good people, the people that you rely on. How dependable is this? What's your track record? How well have you done? Have you had a situation where you thought this or that business leader would be really good and turned out that he wasn't? And he said single digits, that it's less than 10%. And that's a pretty good record. His growth fund has broken down, as you can see. But again, I think we're very close. If you look at that red line, close to a bottom pattern like we have in the past. And in fact, it's dipped below that red line a couple of times. So I think we're definitely moving toward a bottoming pattern. Now, we used to have the Ahren Partners Fund, which we did really well with because it had a huge position in Tesla. So this is the thrill of victory and the agony of defeat. But we wisely got out of the Ahren Partners Fund that had a 49% position in Tesla. And you all know how Tesla has really collapsed, virtually collapsed the stock price anyway, in the last year. We dodged that bullet. I just want you to know that we're very careful on what we hold onto. But the Ahren Growth Fund has no Tesla position. I think it has really good upside potential. And who knows, maybe even Tesla will make a comeback. I mean, Elon Musk is one that Ron Barron has doubled down on and thinks is a very positive future in the long term. But the stock was just acting too negative for us, so we got out of that. But we still like the Ahren Growth Fund.
Did you want to go over the quotes or move on?
Oh, yeah. So these are indications of the strategies of very successful money managers. I buy companies, not stocks, and even more specifically, Ron Barron, we invest in people, not businesses. And then Finer Peter Lynch, in this business, money management, if you're good, you are right 6 times out of 10. And I think that's really true if you look at Warren Buffett, if you're Ron Barron, you look at Peter Lynch, all of these great successful money managers, hey, they're B or B minus in terms of their grade, student grade. But the rest of us are C or C minus or D or sometimes Fs. So they outperform the rest of us, but nobody is an A student in this business. It's really a tough business, and you should not lose confidence in a money manager or an investment newsletter writer like myself who don't always make every decision as profitable. I mean, the majority of our positions have been profitable. We try to do a really good job, but nobody's perfect. So this is where we get into the dividend policies. And here I am, a meeting again prior to wearing my hat, or when I'm at a restaurant, I take my hat off. And when I'm in a church, I take my hat off. And here I am speaking with Jeremy Siegel. Jeremy Siegel, the Wizard of Wharton, has done a lot of work. He just came out with his new book, Stocks for the Long Run. And he's really a sharp man. We've known each other for the past 20 years. So here's this wonderful chart, which done by Ned Davis Research, and he demonstrates the power of dividend-paying stocks. And this quote from Jeremy Siegel that I have in my portfolio that fit that category. But this index demonstrates the power of dividend-paying stocks. And notice that it is the best performer, and the worst performer, the one that's down the green, the dark green, or the dividend cutters and eliminators. You see, if a company cuts its dividend or eliminates its dividend, that's not a good sign. So that is underperformed. But the other thing you'll notice on this, the dividend-paying stocks do not avoid the bear markets that occur from time to time. They are cyclical, just like all other stock positions. However, what's really beneficial is they cushion the fall. So they keep paying a dividend during the bear markets, during the recessions. And that helps you survive and feel better. That dividend is coming in. And I'm telling you, some of these stocks even increase their dividend during these recessions and bear markets. And that's a good sign that you need to stay with that company. And we have some examples of that. So Main Street Capital, this is, here I am with the two CEOs of Main Street Capital. You can see that Main Street Capital had some difficulty in March. of 2020. There you see the collapse in Main Street. There was a collapse in all kinds of stocks, but we held on. Now, what is Main Street? Well, Main Street is a private investment company that invests in private companies that eventually will go public or merge, be bought out. And they have a track record that is unsurpassed. They have over 98% of all of their investments have turned to be good deals for investors. And that's an incredible record, believe me. And it's got a great symbol, Main, M-A-I-N. Go back a little bit more about Main Street Capital. So Main Street is one of those who continue to pay a dividend and even increase their dividend during these bear markets. In 2020, the stock was down like 13%, but the dividend was so generous and they increased it 3 times during this bear market that we were only down 10% for 2020, and we're already up for the year in the new year, 2023. So that's the key indicator. If you're in a bear market and they continue to pay a dividend and increase the dividend, and they pay monthly, by the way, so if you want monthly dividend, it's hard to beat Main Street Capital. They have done really well. So there's an old saying on Wall Street, the stock market takes the stairs up and the elevator down. We certainly saw that in 2020, where it was steadily, Main Street was steadily moving higher and higher, and then took the elevator down, but had a really nice recovery, as you can see in it. And this is, I don't know if this is total return or if this is just without the dividends. But
yeah, that's probably without the dividends. Most charts don't include the dividends, which I don't.
Yeah, so you include the dividends here, and we're way ahead. So it's really been a great play.
Yeah, it's got a nice dividend yield.
And then infrastructure investing, I think, is really a hot area and a growth market. You know, all the great investors say, stay invested in industries that can't help but burgeon over time. Infrastructure has been neglected for many years, and now it's finally coming into its own. We can see there was a dramatic move up, and even during the bear market of 2020, it held up pretty well. It was almost basically break even. And they have a rising dividend policy. They're based in Toronto and New York. Brookfield is the #1 investor in infrastructure all over the globe. Rising dividend policy every quarter, really good outlook, and they're getting involved in a lot of infrastructure projects, whether it's roads, the internet, the bridges, ports, all of these areas that really need a lot of work. And believe the United States, of all countries, needs to beef up its infrastructure, that's for sure. So we really like Brookfield. We're fully invested in that. And ExxonMobil, look how that chart is done. Of course, they had trouble in 2020. There was fear that they were going to have to cut their dividend, but of course they didn't. ExxonMobil, the world's largest oil company, has really been a great performer. We like it a lot. So ExxonMobil is a really good, you can see the charts really look very strong there. And here I am interviewing David Rockefeller, the grandson of John D. Rockefeller. And that was quite an experience to meet up on the 56th floor of the GE building, the NBC building in Rockefeller Center. This was quite a treat. I did this to interview him for Forbes magazine, and reminded me of the great quote from John D. Rockefeller. Do you know the only thing that gives me pleasure? It's seeing my dividends coming in. It's so funny. So what gives him pleasure? Not his wife, not his kids, not his friends. It's seeing those dividends come in. And I always ask the audience, how many of you actually feel that way? And quite a few hands go up.
Yeah, I'm always amazed how many hands go up. But, those are probably the divorced ones. They're probably the divorced
that's probably it. That's probably it. But ExxonMobil has done really well. Now, gold is a very volatile. This is another sector that we're looking at. And you can see gold has started to make a comeback here in the last few months. And so we've added both gold and silver to our position. And in our trading services, a number of gold mining companies that are doing well. And I like this quote from Richard Bann in the Maxims: "When the pundits say gold is dead, it's time to look for a resurrection." And I think we're seeing that right now. So we like gold, especially with the inflation going on. Yeah, I think it has a real potential. So that's one of our main areas that we like to focus on.
All right, and the next slide is Mark's #1 energy stock for 2023, and there it is.
Yes, indeed. And like Exxon, you can see that Enterprise Products Partners has been moving up. The long-term trend, that blue line, is definitely positive. And again, this does not pay the dividend. Now, why would I recommend this over ExxonMobil? And the difference is that Enterprise Products Partners has a lot of unique features. It is the Houston-based pipeline and energy storage company. And as a pipeline company, 80% of its revenues come from tolls, the fees that are charged for oil and gas to go through their pipelines. And they have 55,000 miles of pipelines around the United States. And so their income is pretty steady. Meanwhile, they're continuing to expand because oil and gas, despite the environmentalist talk and the worries about global warming, the fact of the matter is that alternative energy of wind and solar and so on just are not dependable. And they're not as productive as oil and gas, the fossil fuels. So we're not going to be eliminating fossil fuels anytime soon. In fact, you need fossil fuels to produce the electricity in many cases for these batteries and so forth that are used in electric vehicles. And, there's been a lot of negative press lately experience with the electric vehicles during cold weather. So there's a lot of reasons why oil and gas, the future of oil and gas is still very positive. And there's no safer way to invest than Enterprise Products Partners, EPD. They have a rising dividend policy. This will be their 25th year of increasing their dividends. So they will now become members of the Dividend Aristocrats, which are companies that have increased their dividend for 25 years or more on an annual basis. And it's a very exclusive club. And it means that a lot of indexes will add Enterprise Products this year to their index, to their ETF. So that is also very positive. So again, you saw that collapse in oil and gas back in March, but it came roaring back and now is looking really quite good. So I think the trend looks really good. This is my #1 pick for 2023 because it's both a conservative position, but it also gives you an incredibly above average yield of 7 to 8% dividend yield per year. Boy, that's a lot of cushion if the stock market drops. So we've been recommending this, probably one of that and Main Street Capital are two oldest positions in forecasts and strategies. So you can see why we think that's really an important investment. So this is my #1 pick for 2023.
Right, wonderful, Mark. And finally, today, as part of our live event to kick off 2023, we are having a lot of $23 specials. So everything today is going to be $23. And so this is the first one. You can get a quarter of forecasts and strategies. So 3 months of forecasts and strategies for only $23 per quarter. This is for new subscribers only. And you're going to stay at $23 per quarter. So it's only $92 a year. It's normally $249 a year. So again, one of our great deals today, all day today, we're going to be doing these $23 specials. And that was my timer to say, we got to wrap it up here. So, but there's a link in the chat window right there for you. So you can click on that and that'll take you to your exclusive offer. We don't have this offer anywhere else. So only $23 per quarter for forecasts and strategies. And Mark, I want to thank you for a great presentation, and thank you for disclosing your #1 pick for the year. And we look forward to everybody joining Forecasts and Strategies. Any final words for everybody?
Yeah, I just wanted to say that I've been writing my newsletter. I'm entering my 43rd year, started in 1980 when Ronald Reagan was elected president. So I've seen it all: bull and bear markets, boom and bust, stock market crashes, one of which I predicted in 1987. And so I'm a survivor, and I encourage you to join with me and know the signs of the times. Thank you all, and remember, fellow free marketeers, AEIOU. So long.
All right. Well, thank you, Mark. And yeah, everybody click that button to subscribe to Forecasts and Strategies. And we'll be back in just a few minutes at 1:25 Eastern with Jim Woods. And his topic is the #1 way to play a volatile market in 2023. So I'll see you back in a couple minutes. Welcome back, everybody. I hope you're having a good show so far. We had a great panel, and then we had Mark Skousen speak. And I want to remind everybody to subscribe now to our YouTube channel. Just hit the button right below this video to subscribe now. And there's content every week, at least on there, new content. So be sure to subscribe now to that. And our next speaker, as you can see on the screen, is Jim Woods. Jim, how you doing today?
Doing great, Roger. Thank you so much. It's always fun to do these live events, and I look forward to them every time you set them up.
All right. Well, we're excited to see yours. Yours is the #1 way to play a volatile market in 2023. So go ahead and share your screen, and let's go ahead and get started.
Let's look at this. Let me get into slideshow mode here.
Just hit from beginning all the way to the left. Oops. There you go, right there. That should do it.
All right. Okay. If everyone's ready, let's get this started. My name is Jim Woods, as Roger just mentioned. Bullseye Stock Trader is the service we're going to be discussing today, because the #1 way to play a volatile market is, as you'll soon see, owning only the best stocks. Okay. So when you are confronted, like we were last year, with a lot of turmoil, a lot of tumult, what do you think is the way that people go to safety first and foremost? But one of the best ways to seek out safety is to seek out only the stocks with the very top fundamental and technical and price metrics. And that is owning the best of the best. So when we want to beat a volatile market, we're only looking for the best, or the bullseye stock trader stocks with our kind of characteristics. So what does that mean? So, well, here's our mission statement. I'm a big believer in mission statements. So here we go. Bullseye Stock Trader, also known as BEST, B-E-S-T, is a stock and options trading service that seeks out the stocks that are outpacing the market in several key areas. Okay. So let's go through these areas, and I'll one by one, and I'll show you how we screen for them and why they end up picking the stocks that they do. So how do we do it? Okay. Well, we start by identifying stocks that have what I call the big 5 major characteristics that tend to drive momentum stocks higher. Okay. Let's start off with the first one. Price is everything. And when it comes to stocks, winning begets winning. And this is not only true in a bull market, although it's especially true in a bull market. But during a bear market, you also want stocks that are outpacing the rest of their peers. So in order to identify those stocks, we screen for the stocks that are outpacing their peers for the past 6 to 12 months on a relative strength basis. Okay. So what does that mean? Does that mean if a stock is up 10% that it's not that good? Well, if the market, most of the stocks in the market are only up 1% or are down 10% or down 20% like they were in 2022, a stock that's up 10% is actually way outpacing the market. So that would have a high relative price strength. So we look at the market as a totality. We look at each stock actually in the market, and we see that we get the stocks that are in the top quintile, the top 20%, or stocks that are outpacing 80% of all stocks in the market on a relative price strength basis. So think of this, we only want the thoroughbreds, okay? We don't want any donkeys in this portfolio. All right, that's the first criteria. Second criteria is what we call earnings power. Now, to the victors go the earnings spoils. What that means is that we screen for stocks that are outpacing their peers for the past several quarters and the past several years, because we don't just want a 1 quarter wonder. We want stocks that have consistently beat on an earnings per share growth basis for the last several quarters and the last several years. And we want those stocks to be in the top quintile as well. So we want stocks with earnings per share growth that are outpacing 80% of the market, in the top 20%. So we already have through the first two criteria, we have stocks that are outpacing the market in terms of price, and they're in the top quintile. And then we also have those same stocks that are outpacing the market in terms of earnings growth. So already there, you're looking at the best of the best in the markets. But there's more to it than just that. We also want to look at technical analysis. This is our third criteria, okay? Because as it's said often in nature, the beauty is in the pattern. Now, once we screen for the best of breed stocks in terms of relative price strength and earnings power, then we need to check out the technical pattern, because this will help us determine whether or not it's a good time to buy that stock or whether we should avoid that stock. Now, here we want the chart to reflect one of several bullish patterns. The top stock is the cup with handle pattern. I'll be showing you some of those patterns as we continue on. Another bullish pattern is what's known as a flat base. And then there's also what's known as a double bottom. Now, these are all traditionally technically bullish stock patterns. And if you can see a stock that has that pattern, you can see that it's in a bullish position to continue going higher. But when you see that bullish pattern in a stock that's also has strong earnings per share growth and strong relative price strength, then you've really narrowed down the field of stocks to just a few that you can manage and kind of assess, and that you can play the market with so that you can beat that volatility. So we use this chart pattern to determine if now is the right time, because we only want the right stocks, but we only want them at the right time as well. So sometimes a stock can be a little bit overbought, and then we don't really want it. It's a little bit too extended off its cup with handle base or off its flat base. So we'll get into that a little bit too more as we drill down into the examples.
And I think it's important to mention, earnings growth, which means these stocks have earnings. You're not picking stocks that aren't making money. So which are the ones that get hammered quicker.
Exactly. Yeah. Now there are times when you can see a stock that is just got strong revenue, maybe not strong bottom line, and maybe some of those stocks have traditionally been good performers. But I tend to avoid those, because if the company does not have a solid earnings growth base, they are very susceptible to the whims of the market, because there's nothing there for investors to really there's no meat on the bones, so to speak. So you want to avoid, in this service, we want to avoid stocks with no earnings. And there's a lot of stocks out there, especially in a bull market, that surge because they have the promise of future earnings, but we don't want the promise of future earnings. We want a solid track record of future growth. So that's an excellent point, Roger. We're looking at these are the best quality companies out there, companies that are making a lot of money versus their peers, and their share prices are doing well, and they have a strong technical pattern. And that leads us to our fourth criteria here: industry leadership. Okay, so when you're hot, as the saying goes. So that means we tend to shop only in the aisles where the best sellers are found. Now, this is a reference to the bookstore. I know a lot of people watching, I'm sure, miss bookstores, or they still can go to bookstores. Not that many bookstores around like there used to be, but I miss that. I like to go to a bookstore, and you see a lot of people in the bookstores. They're at the bestseller area. That's where the bookstores want to sell the most, because that gets the most people there. So think of that when you're looking at stocks. You want to look at the industry leadership, you want to look at where the best sellers are, because the smart money is always shopping alongside you there. Smart money is always looking for the stocks with industry leadership. And if you are also looking for stocks in industry leadership, you're obviously going to be like way ahead of the game in terms of determining what the best stocks are. And how, when you're trying to battle like a volatile market, this goes a long way in helping you put all the factors on your side that tend to make a stock go higher. Okay. So now here's an example of something like that, of the changing market environment. So for a long time, tech stocks, the past several years, they were the leading companies. They were the industry leadership in the whole market. But that changed in 2022. It actually morphed into energy stocks as being the leader. It's actually energy was one of the only stocks sectors that did really well in 2022. So when we were looking at stocks last year, we did have a lot of energy stocks in there. So you want to look at stocks that are leading, that have market leadership, industry leadership, and as that will give you another layer of positive edge when you're trying to pick the bullseye stocks and when you're trying to beat the volatile markets. So finally, this last one, this one's is the most intangible out there, but it's still objective nonetheless. So the median is not the message. The message is the message. That's something that my friend Penn Jillette says, and it kind of goes to the point of what News Q is, because the markets are always trying to give you a message. A company is trying to give you a message, what they're doing, what the market is also trying to determine what the story is that's going to move the market or that stock or any particular industry. So being sensitive to the news queue is something that I think is of paramount importance if you want to identify the best stocks at the right time. So think of like news Q as a market version of IQ. Everyone knows what IQ is. So the higher your IQ, the smarter you are. Well, the higher the news Q you have, the better able you're going to be to identify stocks. So I call it I call it news Q, the ability to take the market's pulse on a specific stock or industry to see if there's enough positive or sometimes absence of negative news that stock that can drive it higher. So it's part science, part art, part market awareness, but really it's a whole lot of applied experience. So this is where the time and grade kind of happens. And when you've been doing news Q analysis since the early 90s, you tend to get pretty good at it. So that's what I can bring to the table for subscribers when it comes to interpreting the news Q. Okay. Now there's another factor here that it's what I call a force multiplier effect. So when we're identifying the right stocks, we also want to identify the right call options on those stocks. Okay. So to supercharge our returns, we use the power of options. Okay? So our force multiplier in this service is we're looking to buy slightly out of the money calls with expirations anywhere between 2 and 6 months out, and that are trading at an attractive price. Okay. So if we're correct about the direction of the stocks that we buy, like based on all of our metrics, our earnings, our relative strength, our technical pattern, our industry leadership, and our news queue, if we're right on all of those elements, then we're also likely to be very right on the call options that we buy in those stocks. So if we're correct and we buy them right at the right time, right as they're breaking out as a new uptrend, then the out of the money calls will rise, like often dramatically. And I'll show you in a moment what I mean by dramatic. Now, this also, keep in mind, is the easiest option strategy that you'll ever find, because all you have to do is see the symbol, put in your buy order for it. You don't have to straddle, you don't have to strangle, you don't have to sell calls, you don't have to sell puts. All you have to do is buy a call option, and specifically the one I tell you to buy when we also enter into a new position. So that's, I mean, you know this more than anyone, Roger. That's about as easy of an option strategy as you're ever going to
Yep,
find.
so it's as easy as buying and selling the stock. It's that easy.
Exactly. Exactly. So, and I mean, not that there's not a place for straddles and strangles and things like that, but in this service, we're looking to just add a little bit of alpha with the options force multiplier. Okay. So I mentioned some of the examples. Now, admittedly, these are cherry picked examples from some of our best winners. So, but it'll give you an idea what kind of returns are open to you and what typically happens actually with a lot of these positions. So, for example, here's a couple of top common stock trades that we made. Thor Industries, we gained a 45.75% in 63 days. In Match Group, we had a 38.07% gain in 41 days. Vista Outdoor, 44.69% in 70 days. Taiwan Semiconductor, 55.45% in 119 days. And every once in a while, we hit these huge home runs. We did that in a cryptocurrency stock called Voyager Digital that was up 244% in 56 days. Now, since then, the crypto area has not been worth anything you want to own. However, at one point, it was a stock that broke out huge on positive news queue and technical pattern. And so that's what we took advantage of. Now, the recent bullseye call option wins, here, this will give you an idea of the power of the force multiplier effect. So Thor, I mentioned Thor Industries. In that same company, we bought the September 70 calls, and those went up 301.81% in 63 days. Other big gains, Costco. We bought that stock, and along with the January 460 calls, we had a 298.51% gain, and that was in 70 days. So that's, we're talking about some pretty big wins in some pretty short time. Our number one performer, one of the top performers that I've ever had, was our Match September 75 calls, and we banked a 447.3% gain in 41 days. So that's the kind of gains that are open to you if you get all of those elements right. And that is really how by getting all these things right, doesn't matter how volatile the market is, you come away with a 447% gain. You're going to be beating the volatility. So,
yep, and a lot of these, a lot of the options, are 5 to 10 times what you got in the stock. So that
exactly
shows the multiplier.
Yeah, the multiplier is anywhere between 5 and 10 times the common stock gain, and actually quite usually it's more like a 10 time, 7, 8, 10 times gains in the calls if you get them right, and that is a kind of those kind of wins give you a huge amount of alpha, and that can insulate your portfolio against other sectors that you might not do well in. So that it's important to really maximize those gains when you get them. So I mentioned Thor again. Here's when this was bought in May 2020, and just a couple months later, we sold it for that 45% gain in the common stock and the 301.8% gain in the calls. Okay, Taiwan Semiconductor. Here's another one. This was bought in September of 2020, and we held it till January 2021, and we made a 55.5% gain in the common, 243.9% in the then November 85 calls. So that'll give you an idea of the multiplier factor there. And also you can see here, look at the chart. Now, if you look at the bottom, you can see the time frame here. So September is when we added the position, okay? And then right after we bought it, it kind of dipped down below that 50-day moving average, that blue line there. And then it soared straight up all the way to that mid-January point, which is the time, which is when we sold it. When it started pulling back a little bit from that mid-January peak, that's when we got out, because we had already had a 55% gain in just a little over 3 months. So, or 4 months actually. So that's the kind of gain that you want and if you get it right, that's the kind of gain that's possible to you in this service. Here's another one, in mode. We bought it on the June of 2021, sold it in September of 2021 for a 67.28% gain in the common shares. Now, if you look at the chart here, you can see that in June, it also kind of broke. It developed like a one of those bullish cup with handle patterns. The handle began in June, and then the stock broke back up all the way up until September, and then it started to break down a little bit towards that 50-day average, and that's when we got out, but not before we banked that huge gain in the calls and the common shares. So you can see here we got that right on all of the different factors that we're looking for. Okay. Here's another one, Costco. We bought it in September of 2021 and sold it in January of 22. Here again, it was on a breakout. Look at the chart there, breakout of September. It actually fell back down below the 50-day while we had it. I was getting a little nervous at that point, but then it staged a rebound, and that's when, and once it broke back out through that September point where we bought it, the stock soared all the way up till the January pullback, and that's when we rode that whole thing up from early September all the way to January, and that's when you know that you've got it right in a position. After you buy it when you buy a stock, you're expecting it to go higher. So if it doesn't, that's why we have a stop loss in place to make sure that we protect ourselves on the downside. So, but if it doesn't go back down, which usually it doesn't, we see the stock go up high, and we see the stock make some very, very good gains. Why? Because we're buying it with the stock with a strong earnings record, strong relative strength, a good technical pattern, bullish news queue, and it's an industry leader. So this is an example of where all the elements came together. Plus, we had that force multiplier that gave us almost a 300% gain in just a few months. Okay, all this wins and all these different performance numbers have allowed me to capture a pretty something I'm proud of. It's a rank by the independent firm. It's called Tip Ranks, and they look at people like us that pick stocks and that write about stocks and that recommend stocks, and they do an independent survey of how they've done. I was recently ranked number one financial blogger out of over 7,000. So it was pretty happy with that. I bounce around in the top 10, but this was relatively recently. They calculated a 73% success rate and an average return of 16.6%. That's including all the picks, the wins, the losses, etc. So very happy with that, and that I hopefully will continue doing that as the year goes on. So here is the basic rundown. I call it my cheat sheet for a bullseye stock trader. So let's go over these factors one more time. And if you want to take a picture of this one, this is the one you want to take a picture of. So we screened for high relative price strength. Then we screen for strong earnings power or earnings growth. And that's over several quarters and several years. Then we buy only on a bullish breakout pattern, such as a cup with handle or a flat base. We also want bullish news queue, meaning we want something there to drive the stock higher. Some kind of news, some kind of industry situation, or some kind of new product, new CEO, something like that. We also want to buy slightly out of the money call options And that's our force multiplier. Now we're going to hold the stocks until the momentum ceases, okay? And then we get out with a profit. If, however, we don't see the momentum, or if we buy the stock and it doesn't perform the way we want, and it slides back down on us, we will not lose more than 12% in any one position. So we keep our losses to a minimum. What's one of the main things you want to do is avoid the big losses. Now, the average days we've held throughout the inception of the service, 56.3 days. That means you're not holding a stock for a very long time because you're buying it at the right time and you're selling at the right time. Now, the average annual return since inception is 122.05%. And that was as of last quarter. So take that out into real money terms. If you started almost 4 years ago now with $100,000, in a year you would have had $222,050. And then that same $100,000 that you started with in about 3.5, nearly 4 years would be 1.6 million, over $1.6 million. So that's a kind of success that you can have if you're buying the best of the best stocks. And if you're facing the volatility by looking at the best stocks out there. Okay. Now, this is something we promised everyone, and this is going to be my free pick to all, because this stock embodies a lot of the same characteristics that we just talked about.
It's going to be a heavy lifter.
What's that?
It's going to be a heavy lifter.
The heavy lifter, yes. This stock is one we actually had before in the portfolio that we had a tremendous success with. And right now it's coming back full force. And that stock is Planet Fitness. Now, you probably are familiar with Planet Fitness. It's a national chain of health clubs, gyms, very low cost memberships, but they get a lot of memberships, a lot of turnover, especially this time of year. A lot of people getting back into the gym, getting back into fitness. Usually the first quarter is usually one of their best quarters. Obvious reasons. People want to get fit for the new year. And that's what's going to happen now. And as you can see by the chart here of the stock, it is very fit. As of the 13th of January, we could see a huge cup with handle pattern building. That cup with handle kind of started really like late September. It was a pretty big dip, pretty big kind of, actually a rather more deep cup with handle than I actually like to see. I like to see a little shallower. But then you could see that late October, early November, the stock started to come back. It was on strong earnings. It was a news queue of strong earnings. Broke back above the 50-day, then broke back above the 200-day, which is that red line there. And then it started kind of trending higher, then pulled back a little bit at the beginning of December, formed another kind of little cup pattern all the way up until the most recently, beginning of January, the handle started really breaking out. And that is when we added it to the portfolio on 12/29. Okay. So technically speaking, a winner. In terms of earnings per share, it's up. The most recent quarter was up 68% year over year, which is a huge gain in terms of earnings per share, relative earnings per share growth, and that the stock is in the top quartile of all stocks in terms of earnings per share growth. Now, in terms of the relative price strength, the stock's in the top 14%. Part of that reason why is because it's up 18% over the last 6 months, leading up to that mid-January 13th period. It has a bullish cup with handle pattern here, as I just mentioned. And of course, the news cue here is that we have a full return to the social experience of gyms post-COVID. Now, this is the key news cue here, but it's not the only news cue. The company is executing properly on all of its metrics, and it's really found a niche, especially now that people really want to come back to the social experience. So it's a confluence of positive news, Hugh, but the main one is people are no longer afraid to go out, work out, be with other people. For most of 2021, that was the case. Some of 2022, that was the case as well. But now it's pretty much over and people are back at it. And the stock is back to where it's now triggered back into a buy scenario, the way it did in 2018 when we bought it and we realized a gain of 23.54% in the common shares in just 77 days. That translated into a 100.76% gain in the calls in 77 days. So I'm looking for a repeat of that kind of gain in Planet Fitness as we kick off 2023. And I think that is a stock that you will want to own regardless if you follow the bullseye service or not. Of course, I hope you do. And I expect to have many more picks like this. But if you're looking for a company to go out there and buy right now, get in the gym and get to Planet Fitness. Okay, now we've approached I think we're coming up close to our time here, if I'm not mistaken, Roger.
Yep.
And I wanted to make sure that I presented you with a very special offer, particularly because you're on this live event and we know you take it serious, and we appreciate that. We appreciate you joining us. We appreciate your following this channel. We appreciate everyone who takes an interest in our Eagle family. So now regularly, this service costs almost $2,000 a year. It's $19.95 a year. But, and this is actually somewhat hard for me to believe, but we have a special 2023 introductory offer, and it's only for new subscribers. So if you're currently a Bullseye subscriber, this deal doesn't apply. Okay, so don't ask. But $23 for the first month. Now, am I correct in that? Right? Is it $23?
That's right. Yeah, all our specials today are going to be $23
all right,
specials.
that makes sense.
To kick off 2023.
Okay, all right. Oh, that's good. So $23 a month, that's like a burger and fries at Shake Shack. So you need to go ahead and do that. Try it out for a month. No harm, no foul if you don't like what you see, but I think you will. If there afterwards you like it, it's about $275 per quarter. But once you have some success of the sort that I mentioned before, with the easiest ever option strategy, and I tell you exactly what to buy, when to buy it, when to sell it. So there's no extra research that you have to do. Tell you exactly why we made the pick, what we expect out of it, and you'll get that. At least you get usually 2 to 4 picks a month. So it's a very active service, although it's not a day trading service. You'll be able to live your life without having to be looking at the monitors all day. So that is my time, I believe.
Yep.
I very much hope that you all join me in this, because this 2023, I think it's going to be a better year. However, it's going to be a volatile year. And so if you really want to beat the volatility, you need to only buy the best stocks. And that's what I think I can help you do.
Yep, and this the $23 offer is, you can click the link in the chat box right now to subscribe. So that'll take you to the order page. It'll give you all your details. But it's, as all our offers are today, terrific offers to kick off the year. Only $23 for the first month. So get in on all these great gains with the best stocks. And so, Jim, thank you very much for being part of our live event today.
Thank you, Roger. Thank you, everyone, for attending. It's been my pleasure. All
right, and then to remind you, click that button in the link in the chat box to subscribe right now to Bullseye Stock Trader, and we'll be back in just a couple of minutes with Bryan Perry, and he's going to talk about my #1 dividend paying stock for 2023. So we'll be back in just a couple of minutes. Thank you.
Thanks.
Welcome back, everybody. I hope you've been enjoying the day today in our virtual event. We had a great panel presentation. We had Mark Skousen and then Jim Woods. And next up, we have Bryan Perry talking about his #1 dividend paying stock for 2023. Bryan, thanks for joining us today. How you doing?
I'm doing great, Roger. Thanks for having me, and looking forward to a wonderful presentation with all our friends and participants here.
Yep, so we'll start the presentation in just a second. I just want to remind everybody to subscribe to our YouTube channel by clicking the subscribe now button below. And we have lots of free content every week on that, and we have lots more things planned. So hit the subscribe now button so you don't miss anything, including these big long day events like we have today. So Bryan, take it away.
Okay, well, Happy New Year, everyone, and welcome to the Cash Machine 2023, my #1 dividend paying stock for the year ahead. Excited to show you that here once we're through the brunt of the presentation here. So as we get into the new year, hey, guess what? We're off to a good hot start. It's been wonderful, wonderful change in landscape here. Sudden shift in sentiment here. A lot of developments have started to fall into place here for the market to start looking ahead for certainly a better performance than what we all experienced in 2022. For the most part, we still had a pretty good year, but in general, the landscape was just very much a lot of headwinds and bear market territory for sure. Now, global banks, they're fighting inflation here, raising rates around the world, and I think we're pretty close to the end of that rate tightening cycle here. So I'm looking for the Fed here to raise rates one more time here in February, and that'll further steepen the curve here, just a bit, but we might even see something as small as 25 basis points, but they may want to just try for a 50 basis point hike in order to insulate what they believe is, just to make sure that the inflation is not going to run away on them on a second run like what happened in the 70s and the 80s. This China reopening is really helping here because it's kind of like damn the COVID virus, full speed ahead, and they've gone through almost like a herd immunity over there at this point. So it's lowering recession risk because demand from China is a key element here to exports and for commodity prices and just for demand for finished goods and services from the U.S. as well as around the world. So that's a helpful sign at a time when it looked like they may go back into lockdown, but they went ahead and stayed with the course, and it's proven to be a good catalyst for the market in general. U.S. high yield market is offering the best payouts that I know in the world relative to everything else out there. And we've just seen the high yield index start to turn higher here, actually punching up through their 200-day moving averages. So there's risk on attitude is starting to come back here to the high yield world. And that's a real blessing for all of our assets here, because there's a very high correlation to when risk starts going back into the junk bond debt market, that we can find to be a big participant in that. So from my standpoint, for income and generating total return, there's no other place to go here but the U.S. because 90% of what we do are domestic assets in Cash Machine, and it's proven to be where we still have a lot of runway ahead of us here for the high yield market to recover and trade higher on the year. As we've seen already here, now the S&P is up against key resistance right now as of last Friday. So I drew a downtrend line here. There's been 4 attempts for the market to try to break this cycle, and each time it's failed. So once again, we're right back up here. The market's trying to pierce this 200-day moving average overhead, and it's important because a lot of the high yield market is correlated to the stock market, as and it's a leading indicator. Usually, the debt market leads the equity market's higher because as fear comes down, greed goes up, and the bond market functions out of fear, where the stock market functions out of greed. So we're coming off a higher low formation here, which is a good sign, because this last failure of the market to trade up through at 4,100, we came back down to 3,800 on the S&P, but it didn't really trade much lower. So this is a good sign here that we might see a much more productive and constructive move higher here in the weeks ahead. Fourth quarter GDP is now being it was 3.8 here about a week ago. Now the Atlanta Fed is looking at 4.1. And I think that's part of because the dollar has really come down here in value against other currencies around the world. And that's a big tailwind for multinational corporations here doing business outside the U.S. That was a big headwind all last year. the super safe flight to safety for and owning U.S. dollars was a big headwind for corporate profits here. But now the dollar's come down here significantly in the last 3 months, and that tells you that there's more of a risk-off attitude, and that that risk is moving away from the ultimate safe haven of the strongest currency in the world, the world's reserve currency, and starting to buy things that are more like the euro and the yen and the Swiss franc and the krona and the loonie in Canada. So other currencies are starting to rally against the dollar, and that's a good thing, because it just tells you that there's more, again, people are willing to take on some more risk than they were even just 2 weeks ago. In our market here, finding stable income in an unstable market is really the hallmark of a really good portfolio, construction. And that's really what I spend a lot of time at, just trying to find really good, high quality business fundamentals where the income is being earned from organic growth and being generated from top and bottom line growth. And, a responsible use of leverage, especially now, since the cost of money has gone up significantly in the last, 3 or 4 months here with these multiple rate hikes. And then it's at the same time, we have to respect where the money flow is. Cash machine is an active, dynamic sector rotation model. So I'm a student of sector rotation, as many of you know this. So I try to follow the money, and I also try to get in front of the money when I start to see, active movements into areas of the economy that, for one, they might make sense initially, and sometimes it's just a matter of, okay, because there's been a lot of money going into cyclical stocks of late, even the home builders, when the data is currently saying, look out for more bad news. But the market's a forward discounting mechanism, everyone. So it tries to look out 6 to 9 months. And the market is seeing better conditions for the cyclical parts of the value stocks that are deeply into the heavy metal industries, iron ore and steel and heavy equipment and materials and industrials. So if the economy were really slipping into a recession of sorts, then those stocks wouldn't be rallying; they'd be being sold on rallies. So we don't want to swim against the tide. We're starting to see money come out of some of the more safe haven areas like consumer staples, healthcare, and utilities are holding up pretty well. But hey, starting to see some good action here in the REITs and things like that. So we want to respect that, and also know that that's where institutional money wants to own. And that's the oxygen of any good sector is when you get a lot of institutional buying, and we want to participate in that, because that's what drives stocks higher, is money flow. Here again, the high yield market is signaling, it just gave a buy signal here just in the last week and a half. And you can see that back in, in mid-December, when everything was looking, pretty ugly, there was a lot of selling here. Santa Claus was a no-show for basically for the year. And we saw a lot of tax loss selling right into the end of the year. And also you saw some of this also with the, because there was just another wave of selling here on the basis that the Fed was going to raise rates and keep raising no matter what the data said. So we've seen a very sharp rally here in high yield, and it has punched up through the black line at the 200-day moving average. It's a very strong move here on good volume also. So a lot of things are improving technically, the advanced decline line, the up days versus down days. It's just, all the conditions are improving. And we just, but again, I want to be sure that, we're going forward here, that it's not another head fake rally and then things start to work lower, because we're still in a market where the yield curve is inverted. That means where the 2-year note is paying more than the 10-year note. And that's, a precursor to recessionary pressure. So we need to see some improvement there also. But, again, we're off to a good start. We're seeing some good movement here, and it's very encouraging. More knowledge reduces fear. This is absolutely true in any business. And, we need to have an understanding of each and every asset that we own. And right now we've got about 25 positions in cash machine. Fully invested is usually between 30 and 33 positions here. I always underscore the fact that people shouldn't put any more than 3% in any of the assets that I recommend. So if something really doesn't, go well for us, a 3% position that suddenly, heads lower is not going to ruin the year for us. And it doesn't, cause a lot of pain from the standpoint of having too much of one thing working against us. So again, no such thing as a casual trade. I take every position seriously. Sometimes they'll start lower and head higher, or they'll immediately jump higher on news and all that. And I won't, if a stock or a position asset gets ahead of itself, then I'll be the first one to sell it here, because it's just, a lot of times when these assets move up, the yields obviously move down. And one of our benchmarks also here at Cash Machine is when a stock or an asset moves up to a point where the yield is trading below 4%, that's just a sell signal for me, because I can find 4% in the treasury market right now. So I'm competing with the bond market and the stock market. And right now we want to make sure that our yield, our blended yield, is paying a better than a double-digit yield. And right now it's around 10.2%. So, we want to drill down and perform, solid due diligence is what I do. I call these portfolio managers. I talk to the companies that run these particular the various different assets that we're in, whether they're common stocks or funds or REITs, whatever they may be. And we need, not just me, but it doesn't hurt to do a little bit of homework on your own too. But my job is to do this for everybody. But having a very high familiarity with what you own and why you own it is important, because sometimes you have a black swan event. What if China does invade Taiwan out of nowhere? Is that going to ruin the party for everything over here? I don't think so, but it would cause the market to react negatively, significantly for a short period of time. But if excuse me, if you know what you know about the companies that you own, and that there's no exposure to Taiwan, then, it's just, it's one of those things that we can all sleep with and know that we're in a good place to be. Constantly check and validate the themes intact. Sometimes, things change in terms of trends, whether it's the onshoring now of high technology, or whether there's going to be, a big, change in energy policy, or whether there's going to be something that, there's a regulatory atmosphere that changes a lot of things about taxes for master limited partnerships, things like that. So it just, it's an ongoing process of the learning curve never stops, is what I'm saying here. And that's my job to have that for you as a client of mine and a customer of Eagle. But again, I do encourage everyone to stay on top of their portfolios if they've got the time. And we reduce the risk through a lot of diversification here. So we have a lot of broad holdings. And as I noticed, as I mentioned, notified that we've got ETFs and closed-end funds, and sometimes an exchange traded note or two. So Cash Machine has a lot of individual holdings, but it also owns a lot of different funds. So what is categorized as a fund of funds approach. And again, we have a good balance right now of 20-25 holdings. I've been adding more here because the market has encouraged, me to start putting more risk on. At this juncture here, you can, if you want to be fully invested, you shouldn't have more than 5% in any position. But when we're fully invested with 30 positions, divided by, 100 divided by 30 is around 3% a piece. So that, there's kind of your balance in here. And sometimes we have, more sector weighting than others. Like right now, we've got more energy in our portfolios, our three portfolios. So I like that position because it is inflation sensitive. I do believe that the global economy is going to, the demand is going to be outstripping supply for the oil and natural gas market. So I want to have a good dose of that. And at any given time, if things change, I'll be the first one to make those changes in the portfolio. This is not a static form of investing. It's dynamic and open to quick portfolio changes.
Yeah, it's one of the things I really like about Cash Machine, Bryan, is, not only getting that 10% yield, but, the sector rotation that you do, and it's really wise. You get the good results because you're in the sectors that are working the best, and you're not just only looking for the dividend yield, but that sector rotation gives you that capital gains on top of it.
Yeah, I appreciate that, Roger. And I do try to hold things for a year and a day because we all want to try to get long-term capital gains. But, if the market dictates that something needs to happen differently, then we need to be able to respond to that accordingly. Again, we have three portfolios here: extreme income that pays above 10%, yields, accelerated income that pays 7 to 10%, and then our safe haven that pays 4 to 6. Current blended yield of 10.2. Energy is our top weighting with variable dividends here. Now, variable dividends are really a key component because it's made up of two parts. You have a fixed dividend, and then the energy company will pay a portion of their free cash flow as also an additional, an added part to that dividend, to the quarterly dividend. So as the current administration has been, anti-fossil fuel, a lot of the big oil and energy companies have stopped, what is called spending CapEx, meaning spending money on future projects for exploration and production, and they're returning all that free cash flow in the form of more dividends and stock buybacks. So hence, we've had a very strong energy market for 2022 that I think is going to still outperform in 2023, especially with China coming back online here. We have double-digit covered call closed-end funds. We have double-digit covered call ETFs that pay monthly. The closed-end funds also pay monthly. I do try to incorporate as many monthly paying assets as possible. And so that's important. We just added a new position in high-yield corporate debt and preferred stocks, both of which pay better than 10%. In fact, the corporate bond fund pays better than 13%. And they're using some leverage in there for sure. But again, I wanted to start dipping my toe into the corporate debt market because of what you just saw with the high yield market starting to break out, coming way off its highs. But still, I think it's a good place to start adding to positions here. And then we've got a hedge that I still keep in place. That's a double S&P 500 inverse ETF, as well as a precious metal hedge, which owns about 60% gold and 40% silver, both of which are breaking out. Gold and silver had a spectacular month, month to date so far. Gold's better than back up to 1900 near its all-time highs. So, again, I want to keep that for black swan events, and in the event that, the current earnings season, for instance, which is on our doorstep. We just saw the bank start to report on Friday. If that's if companies don't guide and say the business conditions are good, or they say that we're cautious, or we're not as optimistic as we were, and the market starts to pull back, I just want to make sure that there's an all clear sign before I lift these hedges, and I don't have that yet. So that's important that we maintain a little bit of a defensive posture while we also add new positions. And here's the beauty of non-correlating asset classes. I try to have a portfolio that if one side is zigging, then the other may be zagging here, because what it does is I'm trying to bring the beta down for the portfolio. And what beta means is if the S&P has a beta of 1, okay, I'd like to have a beta underneath 1, because it just means the volatility in the portfolio is lower than that of the broad market. Okay, so it allows for what a lot of us in the business call a smoother ride. And I want to have a very high yield, but I also want the thrust of the portfolio to not move around very much, except higher. So, and it's a daily tug of war, between inflation. We came out of deflationary period. Now we're in inflationary period. And it looks like, we're trying to find Goldilocks again here. She's out there somewhere, but, and that's maybe why the market is starting to sense this in terms of, inflation coming down, but we still have full employment at 3.5%, but commodity prices are coming down here. And that was really what was driving a lot of the inflation last year, was food and energy prices. So we want to strike a good balance between defensive and offensive assets, and be careful not to, bet the ranch in any particular sector, or no matter how good it looks, because invariably things will turn on a dime in some of these high yield sectors here, like the shipping sector and some of the other more deep cyclical types of sectors. So anyway, we want to maintain, offsetting assets if possible. Not always easy, because it seems like when everything goes down, it all goes down. But, in high yield world, you don't have as many selections as you do in other types of asset classes, like currencies and interest rate swaps and things of that nature. We want to steer clear of yield traps, okay, because there's a lot of high yielding assets out there, but we want to make sure that the underlying, what's under the hood, is healthy. And so if it looks like smoke and mirrors, it probably is, because rising yields a lot of times reflect a stock that's losing value, or an asset that's losing share price valuation. So, we want to give heavy scrutiny to managed distributions, because that just means that they're promising to pay something every month or every quarter, but we don't know if in fact they're earning that, that dividend to justify that managed distribution. And those are usually scrutinized about around February to March of every year. So, I go deep into figuring whether or not the portfolio that they're managing is bringing enough cash flow in, net income in order to substantiate and cover any kind of a fixed distribution situation. We want to look out for one-time payouts that skew yields also, because that can also, when you're screening for, if they're pay a year-end dividend and they count that in there, that's not the average yield. That's just a one-time yield. So you want to be careful and carve out any year-end dividends that are, because of capital gains, because they may not happen next year. And so also I try to, other than maybe the iron ore stocks, which we had last year, the Rio Tinto and BH Billiton, I try to avoid semi-annual dividend payers because, they pay heavy twice a year, but then the stocks really get, they get nailed pretty hard. So you want to catch these on, catch them, after they paid a big dividend, and then ride them up if it's the right cycle to be in, and then maybe capture one dividend there. But they're hard to trade, and this is an income service, so we're not looking to just get paid twice a year. We're looking to get paid monthly and quarterly at best. So that's it's a rare time when I take a semi-annual dividend pair, but sometimes it's worth it. It's a unique situation when that happens. And then the present portfolio structure here is, I'm always shooting for a 25% total return. Hence, I wrote the book in 2006 called The 25% Cash Machine. And that's made up of 10% yield plus 15% capital gains. I think this year we have a good shot at that. Not, last year was last year. This year, we're already coming out of the gate pretty hot. And I really like our double-digit yield here that we've been, locking in here while the market was down. And now, we've got the window at our back to some extent here, and it may carry into the second quarter, and hopefully it will. We're a little bit overbought right now, but I think that the market is on better footing for sure. So I intend to add more risk during the first quarter to attain, more holdings while also keeping our yield above 10%. And again, trying to also maintain a lower beta or lower market risk. So current macroeconomic data and interest rate environment, it's improving, and it's for the benefit of strategic high yield investing. Now, underscore strategic, because not everything's going to work. And we want to maintain a focus on U.S. assets here, which is roughly 90% of what we do, because the information's good. There's good research. They're liquid, and there's, we don't, I like to have just access to markets where, again, they're liquid, and I can get very solid information that's reliable, and less regulatory issues overseas. There's more regulatory issues overseas, as well as, again, opaque type of companies that don't give you good information about, earnings, about payouts. It's just easier for me to do research here and due diligence. And it's also the biggest market in the world here. The market, the U.S. economy is 25% of global GDP. So it just pays to be where we are. So again, we're executing a high yield asset portfolio that can pay out a greater dividend yield than 10% annually and produce strong returns. Okay. And again, I'm shooting for 15 to 20% capital appreciation this year alone. And so, we're going to see some of these assets that I have are going to be unique, and they're going to be creative, and they fly under the radar sometimes because they are, hybrid types of assets. And I think that's fine because, finding really special assets are some of our biggest pairs that we've ever had. And, we've got infrastructure spending going on here. There's a lot of things happening that are going to give opportunities. Like we just got into aircraft leasing, a company that leases aircraft engines. And so this is a unique story, but, the stock is down, 30% from where it was trading before the correction. And we locked in a 6.5% yield, and the stock is already starting to move higher for us. So that's just another case in point. We want to craft this portfolio of blending higher and lower risk holdings to generate double-digit yield made up of correlating and non-correlating assets. So we want to play off the bond market as well as the stock market, as well as the energy market and commodities. The last thing is, knowing when to sell out of a position. So when I see the fundamentals start to deteriorate, I usually just get out. Sometimes the market's going to take things lower because it's in it swoons over a certain set of circumstances. And if I'm comfortable with the fundamentals of what I own, then I'll stay with the program, stay with the stock, or stay with the asset. Also, but if we make a big gain in something, and again the yield drops down below 4%, or the asset itself is just it's extended because of the overvaluation for what they do, then we're going to take that trade also. And there's nothing wrong with taking profits. No one ever went broke taking profits. And I think that's a golden rule. We want to book those gains if it looks like any of these assets are trading well ahead of where they should be.
Take the money and run.
So, friends, my number one dividend paying stock for 2023 is a company called New Fortress Energy LLC, symbol NFE, New York Stock Exchange. It's a relatively new listing here in the last 3 years, and not on the radar of a lot of Wall Street analysts yet, but it will be this year. It's going to be a big player. They're a global infrastructure company accelerating the transition of liquefied natural gas, which is the fossil fuel of the future. And the reason being is because no one's building any nuclear plants out there anymore. Coal is not being used as widely as it ever has. In fact, it's being disengaged as fast as possible by any country that's having to use it. And oil is you don't see many power plants being fueled by oil anymore. Renewable energy only adds to about 7% of the grid in terms of power, and so therefore it doesn't even begin to replace other types of where coal and nuclear and renewables are just those are not really where the demand is. The demand is for liquefied natural gas, which is a form of natural gas that's frozen to sub-zero and then put into a liquid, and then it's shipped around the world on ships and through trains as well, primarily through ocean-going transportation. And New Fortress is a facilitator of all of this. That not only do they own a fleet of ships, but they also rapidly install and maintain and upgrade existing energy markets, if you will. And so the business with natural gas is that the United States is the Saudi Arabia. They're be like the lead OPEC nation in the business of natural gas around the world. We have enormous 100-year reserves, and that's just what we know. We've probably got another 200 years of natural gas that we don't even know about once we start prospecting for more. It's clean, it's green, it's cheap, it's here, it's domestic, it's abundant. And we have a fantastic arrangement around the world to export LNG, mainly to Asia and Europe for the time being, but some of that's going to be going to South America as well. It allows a lot of impoverished nations and poorer nations to really move forward in with their energy policies, and really provide a lot more power to their systems and their cities in a very rapid period of time. And again, if you have a problem in the ocean and a spillage of sorts, it's not like oil that spills and it causes these huge spills and these big problems environmentally. Natural gas just goes up into the atmosphere. If once out of its frozen state, it just becomes gas. So New Fortress, they operate three main divisions here. They got power generation and heat and power, which is in the business of installing gas-fired facilities around the world, and also conversion, where they convert boilers that are using other forms of energy, primarily coal and other types of and oil from days of old, and converting these commercial industrial equipment into LNG operations, as well as supply and logistics, and that's integrating supply and distribution to all kinds of businesses and all kinds of municipalities, states, countries, governments around the world. So they've launched at the end of last year, they made a radical announcement that they were launching a new dividend policy similar to the variable dividend policies that I talked about with the big oil and gas companies like Devon Energy, Pioneer, which is another one that we own here, as well as Coterra Energy. Those are three variable dividend energy stocks that we own that are primarily oil and gas. But New Fortress Energy is completely 100% committed to LNG, liquefied natural gas, and they've decided to significantly return a boatload of their free cash flow to shareholders here. And they started by just the first dividend that's variable dividend was $3 a share that was paid out here in January 12th. So that just hit investors' accounts here, and the stock is is down around to $38 a share. So we're getting at this juncture here at least an 8.5-9% yield here. But companies forecast to grow their income somewhere between almost $6 to over $9 a share this year alone. So they have a very big bullish forecast here. They're looking to generate more than 11 billion in additional liquidity over the next 3 years. That's just enormous. Additional liquidity means that those are called big fat dividends coming your way, which
we like that.
They're going to be using some of that to buy investments to further build their business through acquisition. They're going to invest more in floating LNG facilities, which are big platforms that are off the coasts of these big LNG ports, so that they can dock their ships, convert the liquefied natural gas into they heat it up basically and send it into the pipelines to supply power companies, and then downstream capital expenditures, which means paying significant dividends to shareholders. So I'm looking for this dividend to grow dramatically during the course of this year. And I can't, it's going to vary from quarter to quarter depending on business conditions, but the company's committed to paying out the lion's share of their free cash flow to shareholders like you and me. And at the same time, I think that with the stock down here, it was trading as high as 55. Now it's around 38. I think the stock's going to trade to new highs here during the course of the year and be a very strong investment here, hopefully for the next several years. It just depends on how long the LNG story goes, but it's a secular trend, and I'm looking for the stock here to be a big performer for Cash Machine. Roger?
Yeah, well, it's a very interesting pick. I'm sure most of our viewers have not heard of this, and lots of great things. So to find out, follow this stock and follow all the sector rotations that Bryan does in Cash Machine and his 3 portfolios, his 10% combined yield. Where you can get 10% combined yield anywhere? Nowhere. Cash Machine. So we have a terrific deal, just like all day today. We have these $23 specials. Cash Machine is no exception. We have $23 per quarter for Cash Machine. Unbelievable deal. Great way to kick off 2023. So click the link in the comment section right now and take advantage of this special deal for Cash Machine for only $23 a quarter. And so Bryan, we thank you so much for spending time with us today. A great presentation. Cash Machine is just always consistently over the years just been a cash machine. Just it's got a great title, and again, for $23 a quarter, you can't beat it. So click that button in the comment section now to subscribe to Cash Machine. And coming up next is somebody actually 2 people who are new to Eagle. A lot of people don't know this is kind of their debut at Eagle. Hugh and Ahren from Day Trade Spy, newest additions to Eagle, and they will be up in just a couple minutes. So I'll see you back here in just a couple minutes. Thank you. Well, welcome back, everyone. I hope you enjoyed Bryan Perry's presentation, and we're about halfway through this great day, the Eagles virtual event today. And I want to remind everybody to subscribe to our YouTube channel, hit the subscribe button right below this video. And we have content every Wednesday, and we have more things in plan. So more and more is coming, and we'll have more live events like this. So make sure you subscribe so you don't miss anything. Next on the agenda, we have both Ahren and Hugh from Day Trade Spy. And for those of you who are familiar with Eagle, you might not be familiar with these two gentlemen, but they are brand new to Eagle. We just brought them on board. So welcome to the Eagle family, Hugh and Ahren. And we're very excited about having them. Day Trade Spy, just as what it says. They trade options on the SPY, and they do it extremely well. And we're very fortunate to have them as part of the Eagle family now. And you'll see more of them in the future. We're making some new plans on a new website and a whole bunch of more stuff. But welcome, Hugh and Ahren, to the first Eagle event.
Thank you very much, Roger. Really excited to be here today. Really excited. Really excited.
Thank you, Roger.
All right, well, Hugh, I will turn it over to you and let you take over and share your screen, and you guys can go through your presentation. All right,
Thank you very much.
There we
Okay,
go.
listen, I make no apologies. If you want to learn all that stuff out there, and if you're worried about galloping inflation and soaring interest rates and looming recessions and stuff, we don't care about that, because what I tell people is, look, if you want to make money, go make some more money, and here's how you do it. You don't have to get a second or third or fourth job. This is where you got to be. Day Trade Spy options. That's what it's all about. And welcome everybody to the top index to trade options on in 2023. It's going to be a very exciting year. So my name is Hugh, and Ahren's here with me, which is just awesome. Together, we are a dynamic duo, Ahren. I tell you, ever since you came on board and the two of us together, it's just, what's our motto? When our indicators unite, our trades ignite.
Yep.
That's not just a motto. That's actually true what it is. So here we are here. I'll tell you right now, folks, I'm the good-looking one here on the left, but Ahren's the smart one. So, that's well,
I thought I was the good-looking one.
All right, listen. What I'm going to do is I'm going to quickly go through some of the trades here that I did already this year. All right, this year, the first couple of weeks, I'm not going to spend a lot of time. I'm just wanting to show you that this is not, pie in the sky. It's not smoke and mirrors. These are real trades on Tastyworks. Those of you who know Tastyworks know that there's no sim account. These are real trades, real market conditions, real trades. I did these before a live audience. This is the money I had made in this, this time frame here. Just a couple of minutes, a few minutes, 6 minutes, $100. Here's one. 57 minutes on 20 contracts, $150 on 2 leggings. A lot of these, all right, they're just a few cents, but we're pulling in $270, $310, $120 all the way up there. An average investment per 10 contracts, $43.91 on this. Take a look at the profit already. This is for the first week only, $27.55. First 4 days. The first day was actually a holiday, so this is only in first 4 days in 2023. The average time in a trade, excluding one overnight position that, by the way, Ahren suggested, which was great. Thank you, Ahren, because I pulled up $1,230 on that trade. Average time, 15 minutes a trade. My stress level was low, didn't even break a sweat. The fun factor was very high. Real trades, real cash, Tastyworks, nothing filtered. You're getting, folks, what I'm showing you here is the good, bad, and ugly. You're getting it all. This is what I did the second week. Again, 13 minutes, $200, $310, $100 in just 1 minute trade. Some of these are 1 minute trades. 9 minute trade, $160. Another one, there's a couple hours for $100. $110 in 6 minutes. Another 6 minute trade for another $450. These are all on 10 contracts, folks. You can go back and check these if you want. They're all there. This is the trade. This is just an actual day in January, just now. We pulled up $80 on 10 contracts. That was in 60 minutes. 180, 130, 180, 170. Total profit for the day, $737. Take a look. We were done by 10:06. I was in the market for something like 36 minutes for $737. This is real stuff. It's dynamite stuff. Folks, 23 winning trades in 9 days, 0 losers. Total gains, $59.52. Average buy price, I was only in a trade here for $4,340. Right. So it's not a lot of money. Folks, do I have your attention on this yet? Because this is where you need to be. You want to make money. You want to forget about inflation and all that stuff, all those problems. I don't worry about that. I don't really care. And I'm going to apologize right now if I sound arrogant or really out there, but it doesn't matter to us day trade spires how much gas costs or groceries costs or anything else. We go out there and we make the money that we need. And I know it sounds really aggressive, but this is what it is. So
and
here's the standard.
That's why I brought you guys to Eagle, and because these do happen. Your track record's amazing, and it's great. Quick for those who want. I've had a lot of my customers ask, I want more trading and more short-term trading. So here we are.
This is awesome. When I discovered this, it was actually quite by accident. And a quick background here. I used to work for corporate America. I used to be an internal auditor for an insurance company. And like, the good salaried employee, I would hand off a lot of my money to my financial advisor. And then when I realized he blew up half my account, I said, I got to seize control of my own account and start doing this myself. And that's when the things really started to flow. Obviously, I went through a lot of peaks and valleys through this whole thing. And there's probably nobody here who lost more money than me. But let me tell you, I learned a few things along the way here. And then when I realized I was making a lot of money, people started asking, Hugh, what are you doing? What are you doing? I said, well, I'm day trading SPY options. Well, can you show me? Can you show me? Anyway, folks, you alone are responsible for all your own trading, and past performance does not guarantee future results. I think you know that. So this session is going to cover introduction, why SPY, why now, why day trade SPY. Very important. I've got a basic strategy you can use right now for some modest, consistent gains. It's about 87% works without any, just follow that and you'll be right 87% of the time. And then we're going to take a look at Ahren's deep dive analysis for increased profits and reduced susceptibility into some losses in this thing. This guy saved me from some losses. Let me tell you, he's great. And this is going to be very exciting. And then your next steps in becoming an expert trader for 2023. You got to pay attention, folks. All right. And I know that some of you are not. And Frank, come on, get back on the monitor here. I know you're not paying attention here. Folks, very important. This half hour could change your life. SPY options, this could be your best choice for today. We day trade options on SPY, period. That's all we do. I don't do anything else. I don't care where other stocks or ETFs are going. SPY all the time, all SPY all the time. Why SPY? First of all, and I'm really moving ahead fast here because I want to get Ahren in on this. So SPY is the top 500 stocks. It's the stock that follows the top 500 stocks. So what we have here is so here's a sample, the first 20 stocks by weight. Apple is at the top there with 5.8% of the weight of the S&P 500. In other words, if Apple went to zero tomorrow, technically, of course, it's not really the way it's going to happen, but that should not really affect SPY that much. So it's not like any one stock is going to have that much influence on the overall ETF. So rather than having to do all these analysis on stocks and sectors and you name it, all you have to do is say, where is the economy going? Which is great because you can just get in front of your computer first thing in the morning, check out what the news is and see where it's going, and then go in that direction. You're probably going to be okay. So this stock follows the S&P 500. And then it's also the most diversified. Sometimes people ask me, why don't you diversify? Well, I can't think of a more diverse. All 11 sectors are represented right here in SPY. This is the greatest thing out there. I got to tell you, it's also the most liquid. It's not uncommon to see 100 million shares of SPY traded every day. I have seen it well over 400 million some days, and other days I've seen it, a little bit lower, 70 million, but generally 90 million. This is a very normal day. 90, 100, 120 million shares a day is traded. And why is liquidity important? Because you want to be able to get in there and buy and sell your options quickly. Okay, you don't want to have to wait. It's also very affordable. Here's the highs and lows. Take a look at this typical day here. A low of 4 cents and a high of $3.41. Folks, I'm not trying to make 100% or 10% even, but can I not make 5 or 6% a day? And it's also very affordable. I can get in there and with even just a few $100s, I can buy a single option. Now, the reality is I'm not going to just buy one option. I'm going to buy 10 or 20 or more, right? So it's also what I love most about it. It's exciting, and it's just the most exciting trading out there. Very profitable, and it gets my blood flowing every morning. So, all right, now more than ever, why trade SPY more than ever? Well, you can work from the safety and comfort of your own home, work whenever you want, as much or as little as you want. There's no overhead to worry about, no inventory to maintain or buy and sell. You don't have to worry about that stuff. You have no employees or government agencies to appease, no customers to procure, service, or try to collect from. Good luck with any other bricks and mortar business on that one these days, right? And you can start with little capital. Your potential is unlimited, and you are rewarded for your skill. And guess what? There's even some favorable tax concessions that you can have with day trading SPY options. I think it's all very important. SPY, the power of options, very, very powerful indeed. Let me tell you, you're limiting your risk. The way we trade, you can only lose what you put into the trade, all right? We do not trade spreads, no complicated spreads. We do not go into the ultra-high selling of naked puts or anything like that. It's actually, I don't want to use the words easy or simple, but we try to uncomplicate things so that it's actually not that onerous in trying to find the profit potentials in this trade. The moves are also quick, like I showed you earlier. In a couple minutes, I'm in and I'm out. And it's great for guys like myself who like to talk fast and act fast. See, the way I look at it, Roger, is this. I don't have that much time in this world, so I've got a lot of things to do before I die. That's why I got to move forward fast. But I love options there. The leverage is huge. You don't need a great big move in SPY to make a lot of money in the options. And that's what's really cool about it. We day trade SPY. Why day trade SPY? Well, over the years, we figured out what works and what doesn't work in both trading and training. Folks, we've been teaching people since 2010. Our trading room has been going since 2010. And frankly, I don't know of any other trading room that's been going that long. Maybe there is, but I'm not aware of it. So trading with day trade SPY, we have the experience you need, the personal support that you crave. We've got the value pricing and everything you do, everything we do. All right. You're not going to get approached here and for the massive upsells and, oh my gosh, you want this? Okay, that's another $20,000. That's another $30,000. I think it's impossible to spend that much money with us. We're actually very approachable too. We're very accommodating. We are of service to you. And we have no hidden agenda or costly upsells. I gotta tell you, I make most of my money with trading options, So that's really, as you saw earlier, right? And here's the thing: we trade what we teach, and we teach what we trade. I don't know anybody else who does that. And we have proven programs that work. All right, I think that's really, really important. We teach what we trade, trade what we teach, and that's why you are going to hopefully be successful, just like we are. Why day trade SPY? I'm going to tell you something right now. Experience between myself and Ahren, I'd say we have 40 plus years of combined market participation. I think that's really important. We have programs, and our programs are hands-on, real-time, real market environment training that actually works. One thing you don't want to do is get into a program that's just theoretical. Well, it looks good, but I don't know if it really works or not. Ours do work, and we're also very cost-effective. You simply cannot afford not to engage our services. I think that is really important. When you find out what we have coming up for you, you're going to see what I'm talking about here, right? And now I have a basic strategy you can start with tomorrow. Okay, now pay attention. It's going to go fast. Even novice traders can master this. Take the 5-minute chart. By the way, these charts are courtesy of TD Ameritrade Thinkorswim. That 10 line there, that's the 10 exponential moving average. The red line's the 20 exponential moving average. This is where you're going to buy right there when the 10 crosses the 20 on a 5-minute chart, okay? Here's what you do. You buy the 5-minute chart, buy the 10 crossing over the 20 EMA, immediately put it up for sale for 6% gain, okay? And that trade, this particular trade was over in a few short minutes. It took the option, this is the chart of the option right here in a 1-minute chart. It took that option from $4.20 to $4.46 plus. It actually even went much higher in a few short minutes. I'm going to give you some tips on this very simple strategy. Buy the at-the-money options by next Friday's expiration for time because it gives you a lower theta loss, lower time loss. Immediately put it up for sale. Go for just a modest 5 or 6% gain. Be prepared as options may fluctuate. Options don't move in straight lines. They vacillate up and down, all right? And it might go down against you, but if you just hold on to it, it's probably going to be okay. Use a good till canceled sell order and consider a repair only if the option stops or drops 40 to 60%. Control your emotions, very important. Watch your greed, fear, ego, and FOMO, and do not overtrade. Stop when you hit your daily target. Call it a day. Move on to the next thing, all right? Folks, we are predetermined on fundamentals. That's where we get into a trade. We trigger on technicals. and we stay on course using our mental aspects of trading. Okay. Now I'm going to flip this over to Ahren because he has this deep dive analysis, which I absolutely love. He has an extensive technical analysis background, and I'm going to just kind of quickly go over this here. I'm going to get, this is what I get out of Ahren's analysis, and I think everybody else in our trading room does too. Enhanced confidence. When further study supports trades, greater gains for potential for the initiated on this one here, and you also get protection from entering the wrong direction. So when Ahren does his analysis, let me tell you, things change really quickly here. And I'm going to hand this off to Ahren here. But Ahren, can you just give us a brief background here and tell us this is an amazing background, folks? This was a coup getting this guy. So it was.
Yeah. So I've been studying technical analysis in the stock market since I was a teenager, and I bring a lot of experience and knowledge and understanding to Day Trade SPY, and I'm here to help you to see through my eyes and look at the patterns and support resistance, Fibonacci retracements, and other things that we use, or at least that I use to help to analyze the markets and help Hugh in making market decisions. So I did work at a fund as an analyst, and I was a E-mini S&P futures analyst mostly, but I do have a lot of experience also looking at Forex and other vehicles, including stocks. So what we can help you to do is, when we're in the room every morning, we look at major market turning points, and so we use some of the indicators that Hugh had talked about, and then you'll see some charts that I bring up. And as Hugh had mentioned, when our ideas unite, our trades ignite. So it helps us to spot market turning points and extensions before and as they happen, and to also achieve greater clarity in the market for the rest of your trading day. So going forward, this is a recent chart. So we had a ABCD pattern that just continued, and we called it live. It hit a resistance point, and it continued to drop as we had predicted it. When the market came out the next day, around the 384 area, I had talked with you, and we both came to agreement that the market could possibly turn and continue downward. And so, those areas we come up with live as we're trading, as we're talking. So we analyze the market and present the best possible scenario, and also can give you a roadmap for the rest of the morning if you do decide to continue to trade after we're done. This is a recent prediction down using some of my techniques here with the Andrews pitchfork. So the market opened low, and it continued to drop, and it continued to drop into support area at the 379, which is a recent strong support area in the SPY, as well as the futures market. So it stuck around there for 379, and we called a reversal recently as well at 379 level.
I want to just interject here. When you called those moves, the market didn't just go a little bit, it went a lot. And I know people made 20, 30, 50, 60, 70% or more on their trades for those people that stuck with it. So where I go for those smaller gains multiple times, you go for those massive gains, and it's uncanny how accurate that was. And I can't applaud you enough to identify those levels there. And that's phenomenal.
Yeah, and one thing I want to mention is, I'm sure some people are looking at this and going, look at all that stuff that looks very complicated. I don't understand it. You don't have to understand it. That's what Ahren's there for. Ahren's at a level that is much higher than I am. He's so much smarter, but he can look at these things and as Hugh says, it's uncanny. Like with all these lines going this way and that way and that way, and he looks at them and goes, okay, boom, and it's amazing. So right, back to you, Ahren.
Oh yeah, thank you. This is a recent prediction. I believe, if I remember correctly, news had come out at the 384 area, and price had dropped all the way down. It hit one of our upward sloping trend lines, which corresponds to the Andrews pitchfork. So not only did we take I believe we took a trade to the downside in one of our methods, but then we also took a reversal trade to the upside. So we were in both the puts and the calls. So in this example, you would have made money on both sides of the market, even before most people, decide whether to put a position on or not. So another example that we do and how we teach and how we talk in the trading room can definitely help you in the markets.
Every day. Every day. This is what's funny about it. It's not just a one-off or once in a blue moon. Every day we go through this. So here's the next slide.
Yeah, and this is just a more of an examination of that last example where we talked about the 384 areas as possibly being resistance pre-market. We took the trade to the downside, and then we called the possible reversal as it happened at the 78.6% retracement level, and people were kind of astonished. We call this the yellow brick road in the trading room. So the news confirmed the trade to the upside, but the price had started to reverse at the 78.6. And we had talked about, if you're a little bit more aggressive, go ahead and you might want to consider buying some calls here. But we ended up waiting for the news to come out, and price continued up to the upside. And everybody that was in those calls that took that trade made some money.
Well, I can tell you that that I got some pretty good emails saying that they did take the trade, they stayed with it, and even after the trading room, they stayed with it. And then by the end of the day, this thing shot right up. And they're asking, how does he know that? How does he know that? And I know a lot of people want to learn, and I think that's going to be coming, right? You're going to be teaching this. There's a lot of things I think we're going to be doing here. I'm very excited about all the different things we're going to be doing. But so I think this was an amazing. Do you remember what your trade went up to on this move here, Ahren?
I don't remember exactly that trade. I think I did believe I got out at the 384, and then I said it was going to drop back, and then it did drop back off that level. And I said if you want to re-enter after that drop back, that you could re-enter for calls, because it did look like the market was going to continue to surge. And if anybody is looked at the recent market action, I believe we went all the way up to 397 or 398 recently, and this is back almost near the bottom, basically, of a long-term Fibonacci retracement level that we talked about for at least 2 weeks. The 379s where heavy buying was, and that people were adjusting their portfolio, and that hedge funds were probably allocating some of their positions to the long side.
Well, that's really awesome.
And that's a good point about the hedge funds. One of the things I've learned from Ahren since he's come on to Eagle is a lot of the big hedge funds, this is what they're looking at. And so you're able as an individual investor to get into what the big boys are doing, because Ahren's a big boy and he's in there, he understands that, and he's got that training background. So just another reason that he's so successful.
Yeah, and this is another example that we talked about. Prices coming into resistance. So the news reaction that came out at 8:30, we talked about. I believe it was for the pick of the day, or the OMG, but I believe it was the pick of the day was for the puts. And then you got out of the puts and right at support, and then that 379 held because there was large orders there, both in the futures and in the SPY. There's large orders there at the 50% to take price back up to the upside, and that's exactly what it did. It stopped pretty much on a dime and reversed for the rest of the day.
That was really awesome.
So we kind of spot these areas and we call out these support levels, and we look for targets, and we look for areas that price could possibly reverse. So you have Hugh, who is very experienced and quick in and out trades, but you also have me, where I can kind of give you some levels and long-term projections where you can actually, whatever your trading style is, I consider us a dynamic duo. So whatever your trading style is, we're here to help you and guide you.
Well, that's the beauty of what we do. So like Ahren said, I've got my set of indicators and they work extremely well. And Ahren's got his completely separate, completely independent set of indicators, and they work very well. So when these things come together, it's explosive. It's like absolutely explosive. Folks, if I don't have your interest on this yet, I don't know what more we can do for you. So let's go on to your next steps in becoming an expert trader. I think this is really important. So first of all, I think for 2023, you have to make a resolution. You're going to commit to mastering our highly successful strategies, right? And accept the fact that long-term success is a process, not a straight line, all right? There's never going to be a single video or a single ebook or a single webinar you're going to go to, and all of a sudden you're an expert trader. It's going to be a long-term process. Those people who are experts in trading, it took them a long time to get there, but we're going to fast-track you to that as fast as we can. Don't forget, between Ahren and myself, we've got over 40 years trading experience, and I want you to take full advantage of all our offerings. So when Eagle and anybody sends you anything concerning Day Trade Spy, I really need you to get involved in that, because the more you engage, the better trader you're going to be. And that's really what it's all about. So now what I want you to do is do this right now. I want you to join the Inner Circle. I want you to join this because this is excellent. This is where you're going to get your first taste of what we do, the Inner Circle, right? What is this? This is where, and this has been going since day one, since May of 2010. May of 2010. This is where we consolidate our pre-opening market, morning market analysis. What we do is we take all of this information that we compile from all these different sources, we compress it all and send it out to you. Is the market going up or down? That's all. There's only two ways the market can go, up or down. And then we tell you what we're going to do. And then later on in the day, we send you a final analysis as to what we actually did. And then we also have our interactive weekly meetups where you can ask all the questions you want. Great for training, great for keeping your skills sharp. That's every Tuesday night. They're also recorded in case you can't come. Okay, they're going to be, so you're going to be sent the recordings, and they're going to be, you're going to stay abreast of the changing market conditions. Folks, here's a sample. This is just a sample. I'm not going to read this. We don't have a lot of time, but it's just a very brief synopsis as to the way the market's going to go first thing in the morning. And there is the follow-up report as to what we actually did, including a screenshot of my actual trades. So the Inner Circle, you're going to benefit from the experience of the expert traders sitting right here in front of you right now. You're going to learn from our treasure trove of relevant tools that we use daily ourselves. And let us do the heavy lifting so you don't have to. All right, we're gonna save all that effort, time, and everything, and get you that all important pre-market information that you need, and of course have your questions answered in our weekly meetups, so you can trade with confidence. The Inner Circle, it costs only $79 a month. That's hardly a coffee and a donut a day. But I'll tell you something. We actually have a very special Eagles virtual trading event. You subscribe now. Believe it or not, it's never happened before. I don't know if it's ever going to happen again. It's only going to be $23 for the first month, and then $79 a month afterwards. Okay. But here's the kicker. There's no long-term contracts. You can cancel anytime. And it's got outstanding support team. Okay. You're not going to be alone. All right. Trading can be a very lonely endeavor, but you don't have to trade alone. You've got some people behind you, some expert coaches behind you. You cannot afford to not subscribe to this, I don't believe. Okay. So that's kind of what it is. All right. Subscribe now for only $23 for the first month, $79 a month afterwards. And listen, 2023 could be a challenge. Other people could be telling you that, but hey, for us, bring it on, folks, because we are here to make a lot of money. And so will you. All right. So will you. Now you are going to become the expert. I want to
mention, Hugh, that you can subscribe by hitting the link that's in the chat room, the chat box right now. So that's how you can sign up for this $23 offer. As if you've been with us all day, all our offers today are $23 to bring on 2023. So hit the link right in the chat box right now to subscribe to Inner Circle.
Absolutely perfect. Right on. There's no reason not to subscribe. Now, here's what's going to happen. Here's what I found happens. It's human nature, folks. You're going to see this amazing presentation. And I know we went fast, lots to absorb. Hopefully you can go through the recording and see it again and again, pick up all those little nuances that we talked about. There's a lot of information that we compressed in here. But here's the thing. There's going to be a lot of you who are going to say, that was a good presentation. You're going to go back to your everyday lives, go back to trading the way you did, go back to losing money, and then you're going to contact us and say, is that $23 still okay? So I don't know, maybe not. And then I'm going to say to you, you should have got it then. Why did you wait? I told you so. And then you're going to go back, oh, well, and then there's going to be some people out there who are going to say, well, I got to check with my husband or wife because I'm not authorized to buy something for $23 without their consent. And then you're going to come back to me later and say, you know what, I should have bought it when I had the chance. You guys were so good. What was I thinking? I left so much money on the table. I don't know what happened. And then I'm going to come back to you and say, man, I told you so. Why did you leave? Why did you not click that link? And then, and by the way, I get really passionate and angry when I hear these things. And then there's going to be somebody else, a bunch of other people. They're going to go, Roger, it happens every time. They're going to go home and say, I got to think about it. I got to think about it. What is there to think about? $23 for a month of professional opinions coming at you every morning at 9 o'clock. The Tuesday night sessions and everything else, you're going to go home. You're going to do your regular trading the way you always have. You're going to lose money. You're going to come back and you're going to say, oh, Hugh, I don't know. Is that thing still around? And I say, I don't know. Maybe not. You better check with the guys. I don't think so. And then I'm going to say to you, I told you so. I told you so. Folks, please, buy, no matter what, buy it now, because I don't want to come back to you and say, thanks for joining us, folks.
All right. Well, thank you so much, Hugh and Ahren, for that great presentation. And so, don't make Hugh say, I told you so. Click that button right now for $23. You can't go wrong, $23. That's why, Eagle is all about education. That's why I founded Eagle. I want to help people. Education makes you a better trader, better investor. And so that's why we were making everything available today for this $23 offer to get you educated and get you going for 2023. So click that button now to subscribe to Inner Circle. Hugh and Ahren, again, thank you so much for the presentation today. Welcome to the Eagle family. We're so happy to have you guys. And up next is John Johnson. So he will be up in just a couple minutes. So let us get transferred over to John, and we'll be back in just a couple of minutes. Thanks, everybody.
Thank you.
Thank you, Roger. Thanks, everybody.
Welcome back, everyone. I hope you've been enjoying the day. We're down to our final two presentations. And before we get to the next presentation, I'll remind you to subscribe to our YouTube channel by clicking the button right below this video. And that way you'll get all our free content and you won't miss anything. We have new content every Wednesday, and we also have some plans for some other things. So, and of course we have events like this, so you don't want to miss out. It's free, so hit the subscribe button now below this video right now. Our next presentation, as you can see, is from John Johnson, and it's how to get my #1 pick every single week. John, welcome to our show today.
Well, thanks. Good to be back, of course.
All right, I'll turn it on over to you and let you go.
All right. Well, today we're going to talk about how to get my number one pick every single week. And we're going to talk basically about the methodology for finding great trades for my stock of the week service, because a lot of people say, these are great picks. How do you find them? And we do all the work for you, but it's good to get a little background. So let's jump right in and start talking about it. We want to get right to it. I'm John Johnson, been editor of Investment House Services at Eagle for 21 years plus now. My theory is you take what the market gives you, doesn't matter which way it's going. And the goal is to get you doing what you want to do when you want to do it. That's the best way to live your life. Well, today we're going to start in by just talking about what is a best play. What's a number one play? Well, for me, it's all about the numbers, as it should be, because we're here to make money. We want to put the probabilities in our favor. So we're looking for the best plays that will put the highest probabilities of winning with a good 15% or so return in a relatively short time frame. Now, finding them takes work. And that's what I said. We do a lot of that work. We do all of the work. But many funnels we have to get through to get there. But we can break it down into 4 big topics to get those plays that are worth putting our money into. Now, the first thing we look at, the step number 1, is what kind of market condition do we have? What's the market giving us right now? And from 2009, when QE started, up through 2021, when it ended, well, we had a linear Fed-supported market that every time it got into trouble, which was when a QE program ended, well, they just put in another one, and the Fed kept pushing that market to the upside. But now, well, we have a little bit different situation. If you were there in Vegas in late 2021, when I was talking, I was out there saying, hey, we're going to have a bear market in the first quarter. And I've been saying that in our newsletter since August of 2021. And sure enough, we did. And we got a choppy sell-off, really volatile back and forth. You can see the market would go up and down, back up, down, but trending to the downside. Well, now we're in 2023. What's going to happen in 2023? Of course, everyone wants to know that. And this is the part right here on our chart, this little bit right here, which takes us to last Friday. And you can see, well, we're coming up to test the downtrend that shifted over from the uptrend back in March and April of this year. And now we're coming up to test it after a higher low. Are we going to break higher? Well, we could. Obviously, we could move on up here, but I still think the bear market has some more growling to do. We likely go lower, make some new lows, get everyone good and scared off. And then that sets up a pretty decent second half, avoiding some cataclysmic disaster out there, which can always happen, but we're pretty resilient. And we've had a pretty good sell-off here. And if we get some new lows, as I said, that'll pretty much flush everyone out and get us set up for a good move higher. So we look at that first condition. What moves are going to get us money? What is the market going to do for us that will let us get in the right position and make good money? Well, right now, barring if we get a breakout, we're having kind of a stocks move up, they fail at resistance, then they roll over, make new lows, more sell-offs. And that's been the trend. So we need to adjust our mindset. And after a dozen years of upside, that was somewhat difficult, but we make our adaptations of our trades based upon the parameters the market gives us. Doesn't matter what we think, it's what the market is going to give you, and you want to take that. So we thus design trades within the confines of support and resistance, old highs, old lows, gap points, prior consolidations. Those all are areas that are going to offer resistance to an upside move or a downside move. And we want to factor those in to our play plan that we're coming up with for each trade that we consider. So that's the first step. What kind of market do we have, and what adjustments do I have to make to fit into it in order to make money, to swing? That's what swings those probabilities into our favor. We're starting and moving towards us when we, admit and acknowledge the obvious. Don't try to play everything upside when everything's going downside. So step number 2, what are we going to trade? Well, we have a kind of a two-step approach, and it's not one or the other. They kind of mesh together. There's an old saying, we used to do a lot of fishing, and it was always fish, good, water. Don't spend your time in the part of the lake just flogging it where no fish are. You get a good exercise, you get a workout, but it's not what you're there for. Frustration, no. Fishing is supposed to be relaxing. So we take an approach where we look, at market leaders. It's like where you see maybe a fisherman's over there got one on his line, or you see the fish breaking the surface or the gulls diving. Well, that's where you want to go. You're in good water then. Go to those leaders. You get a higher probability of catching on to a winner that's moving well. There are some caveats to that, though, and I'll talk about those. And that's why we also have a sector approach. That's a big picture, bird's eye view as it was. You can see what groups are rising, which ones are falling, which ones are just wandering around doing nothing. It helps you find good water, but I really like it because it helps you find improving water. That water is getting clear, the fish are coming into. So what we do is we look at leaders because, well, leaders lead you to leaders. You like to see those leaders moving, and sectors do the same thing because you know which ones are moving up. Now, one thing, though, that just looking at winners and sectors can do is, and I've talked about this in some of my other presentations, is that you can get moves that are kind of late in their run, and that can start narrowing those probabilities down. The window is closing on you a little bit. You get an old move, it starts to degrade, and you have to know where you are in the life cycle of a stock. So what we do is we review dozens of sectors. We're always looking at them every day. That's how we know where the leaders are. But we also look at the sectors so we can start looking at, hey, we got some developments here that are positive. Either they're going up or going down. We don't care. It's positive to us because it's going to make us money. We want to catch those plays as they start, as nearest to the start as we can. It behooves us to get as much of the move as we can. And they'll go up and have series of runs. That's fine. We want to catch as early as possible, though, because puts the probabilities in our favor for wins, because we know good moves are made early in a run. You get the big moves and they slow down after a while, and then it comes back in basis. So we look at where the leaders are, look at sectors, try to find those that are developing into leaders. And that puts the second step for us to getting those probabilities in our favor. So what do we look at? Well, recently we've been playing a lot of metals, where there's precious metals, industrial stocks, and some of the precious metals have turned around. McEwen Mining, we're playing it right now. We started playing this back in October. We were looking at it at one of the Vegas shows. We were there, and they were saying, "Hey, this is an up and comer. This is like the way it looks. It's developing well." Well, it's doubled since then, and after a pullback now, it's down today. It's coming back after a good move. Well, it's going to continue its move on, and we'll take advantage of another play. We're catching the leaders in certain aspects of its run. But as you can see here, we caught it early, and now it's still, even though it's doubled, it's early in its move when you look at 2023. Same thing for Seabridge Gold. It looks like it's just coming around, turning the corner, putting in a nice long base, breaking higher. So these are stocks that have been down, they've been forgotten, but we saw a positive start to gel with them. And so those are the stocks that we like because we can catch them early and they can give us bigger percentage moves. So that's the second thing we do. Now, number three, okay, we've seen the sector, we've seen some stocks that look good. When do we get in? Well, when I was practicing law, we always talked about the lick log. Okay, well, now we're down to the lick log. And that's an inflection point. It's just a colloquial Southern way of saying we're at an inflection point. And the lick log, or the entry point, or the pivot, is where we anticipate that the stock should make its move, and the buyers or the sellers, depending on which way it's going, take charge. So patterns, they focus us into the best entry. We want to capture the move as it starts, as I said. Now, we use patterns a lot, and they come in many shapes and sizes. But the idea behind this is that it's all the same. You can call it a duck or a goose or whatever you want to. But in the end run, a pattern is going to show you whether a stock is under accumulation, that's slow buying by the big names, or if it's under distribution where they're slowly selling it. They can't come in and dump everything at once. So they do it over time, and there's tracks in the sand as to what they're doing. And that's what the patterns let us focus on. And we can look at those patterns and see if, yes, there is actual net accumulation or net distribution going on. Now, oftentimes you'll see this. I'll talk about, oh, it's got a nice rounded bottom or a rounded top. Yeah, that's the general idea. There are a lot of variations on that to give you different entry points, because we look at head and shoulders, inverted head and shoulders, ascending triangles, descending triangles, wedges, cup with handles, double bottoms, lots of attributes that you get down into the weeds a bit, but we'll understand generally. We're getting into the weeds, but you can understand it when you see the pattern develop in those rounded bottoms and rounded tops. So we're going to identify the patterns. We're going to identify the point where the stock should make its move, the lick log. And when it does, well, that's when we make our move. That's when we issue the alert to enter, the case may be, the alert to take those profits. So here we have some.
I'm going to point out real quick, John, that all these patterns and everything. The key here is you don't need to know them, folks. John is the one doing all this and looking at these things all day, every day. But he's also going to explain it to you, because some people want to know more about it, and so you can find out more about it, or you can just take the profits and take the money with the profits and do the trade. So it's up to you either way.
Right, it's kind of a black box thing, and one of the reasons we're doing this, because people are asking, hey, these are great patterns. How do you find them? How do you identify them? And I give you a little background so you can, on each play of the week, you say, okay, here's what we're looking at, and here's why. For instance, Shopify, it's showing a nice little, here's your rounded bottom, right? It's talking about that rounded bottom, and then it's faded, and it's what is formed as a cup with handle, but it's kind of cool because the handle has got this inverted head and shoulders ready to break through some resistance at the 200-day moving average, as well as these other pit points along the way. As Roger said, you don't need to know this, but this is the kind of play that we're looking at. And Shopify was one of those pandemic plays that made a bunch of money to the upside. And then, the pandemic was kind of in, everyone goes, well, I think we overbought. And so everything dumped down. But now it's making great money. I mean, it's always made great money. And all it needed was time to consolidate all those massive gains. And lo and behold, when everyone forgets about it, when it's just quietly working, after it's declined tremendously, it sets up a good pattern because it's still cranking the money out in the back room. And we're going to have a breakout here that's going to make us some money. And look at Patterson. It's the same type of thing. The oil stocks have rallied. They've consolidated. They've rallied. And you can see after a rally into November, we're getting a nice consolidation here. We're looking for a breakout to the upside out of a little cup with handle. It's got so many good attributes to this pattern formed over the 200-day and 100-day moving average. It's got a nice rally into it. It cleared prior resistance. The list goes on and on. A lot of stuff that gets me really excited and I get all pumped up about, and you'll see that when I write it up. And some people, it's like, yeah, well, he's excited again. I guess that's good. Well, again, the market doesn't care what I think. But then again, I kind of check my emotions at the door. I see a good pattern, and it all comes back to the numbers, folks. This is a good pattern. But before we ever get into a play, we've already run the numbers. We've gone through the 4-step process I'm talking about here, these funnels, to see if it's going to make the move we want. And even if it does make the move, if it's going to make us money, because that's the bottom line. And we can find the greatest pattern in the world that moves up, but the options or the stock is just, it doesn't move enough to make us any money. It's a $200 stock and it makes a great breakout, but it doesn't go anywhere. Well, if we don't get our percentage turned, it's not worth our time. And not that we're going to play any $200 stocks here. We keep them much lower than that, so we can leverage the gain for the money that we do put in the market. Okay. Step 4, the optimal target. Got to know where you're going if you're going to know how to get there, they say. But the important thing here, your play is never complete. You never consider entering it until you know where your target is and know whether the numbers will play for you. That's what I was just talking about. It's part of the market condition. We have to know how far up that stock can move or how far down it can move before it stops the move, the play, the run we're looking for, or needs to consolidate and try it again. So what do we got right now? What did I talk about? We have a choppy market. We have buyers and sellers pretty evenly matched. Now, in 2023, they've been showing more buying, and we're starting to see some good action here. But still, do we want to move into a target that's outside of an existing range? When how many times are we seeing a stock move down and get reversed, or move up more recently and then just get slammed to the downside? It makes a good break and it's just got a big old target on it that the sellers are saying, oh boy, let's shoot that baby down, and they think it's ripe for selling and they pile in. So if we want to make a play outside of the range, in order to get our target, we have to break out of the range. We have to defy the market to do it. That doesn't make a lot of sense for us. It doesn't put the probabilities in our favor. So we got to know where the stock can move to with relative ease. We don't want to make it hard for it. We want it to make its move. And just in a routine move, punch the ticket with our target. So we're going to look at all the indications out there that may cause resistance or support for a play we're looking at, where it could stop the move. Will we get our numbers? Will we make good money into that target? Old tops and bottoms. Got trading ranges, stock bounces up and down inside of there. And we love to play those in this kind of market, because if it breaks out of it, it's either going to test and hold and continue to move up. But in this market, they tend to get shot right back down, and then it'll go down and test the old low, or some variation there of maybe a higher low. We'll have to just see. But we understand if we go try to play beyond that level, we're pushing the odds. Gap zones are huge, because that's a big decision point for the buyers and the sellers. Gap up, buyers won, gap down, the sellers won. And if you're playing an upside move toward the top of a range and there's some gaps at the top of the range, fill in those gaps, good, they'll be filled, but then that takes a lot out of the move. And we often see the stock pause and, well, fall back down at those points. Consolidation ranges, you see them where stock just moves flat line laterally in a range for quite some time. It could be on the top, it could be on the bottom. All of these can clue us in as to where our trade can move. And in this kind of market, we don't really want to have to break through them, to break new ground or plow new ground, whatever you want to call it, in order to make our money. Again, that just reduces the probability of success, and we don't want to do that. We want to increase our probability of success as much as we can. So we look for anywhere that the buyers and sellers, they fought to a stalemate, consolidation, or a definitive move occurred, like a breakout or a gap. And here's a chart of Microsoft right now as of Friday. And the reason I put this on here is because I don't consider this a play I really want to make to the upside now. It is in a range, and perhaps it could have been a pretty decent buy here to make a run back up to resistance levels, but it does have many resistance levels above it. And if we look back in time, we start seeing, old bottoms and tops and gaps where it went through this one point here at $250. That's a significant level. I got through it in December. Okay, maybe it's getting better. It did it again in December, but it got shoved right back down. And now, well, it's come back up, and it's at an important resistance level in the 50-day moving averages, this yellow and green line. So in a choppy market, we can play the movement inside of a range. No worries. It's put in a higher low here. Maybe it does break to the upside. But we want to set our parameters for the play, and then thus the numbers, will they work for us, by these old resistance levels, because until the market proves otherwise, a lot of these moves upside are getting shot down still. As I said, there's some green shoots out there for this year, but it may just be the start of the year. It'll play out. These stocks will let us know what they're going to do. But right now, given that I'm thinking, okay, Microsoft will tell me what it's going to do I want to play it right here with all this resistance overhead? I mean, a 10-point move isn't going to give me what I need to make money on this stock, or the kind of money I want to make for the kind of risk that we'd have to put out of pocket. So this is just a good example of how a stock pattern or a price chart can show you all of the pitfalls ahead of you, where you think, wow, Microsoft bouncing back, great stock, leader, it's always there. Yeah, no doubt it's a great stock, always seems to come back, but it's got to go through its base. And we want to get to the point where it's going to make us money, good money, in a relatively short time frame, where our risk is down and the probabilities are very high in our favor. Maybe it'll give us something after it tests this level. And if it comes back and holds down right here again, well, that will be quite interesting at that point. All right. Well, we've seen the 4 steps that we go through, those 4 funnels that we go through for every play. And if we see something interesting, yeah, we'll take it through and run the numbers on it and come up with our plays that way. And then we'll take the best of the best from that. And those are what makes it to the investment house reports. And the stock of the week gets one of the primo cherries, the great plays that we think is going to turn us a really nice profit, really leverage our money and give us a good return with minimal risk, because the probabilities are in our favor. Again, I got to take a look at McEwen Mining. We call it MUX. It's kind of our we just call it by the ticker symbol in the office. We like it. It's a stock that we've played in.
It's a mux have.
Yeah, there you go. MUX have. But this is one of those that I still feel has a lot ahead of it. There's reasons that the precious metals have started to perform lately. Gold outperforming indeed over silver, even silver outperformed in gold. They kind of trade off back and forth. But this one has shown a very good accumulation, excellent buying, and the price is right. I mean, a lot of these precious metals were beaten down, but this one, it's really interesting because it's getting a lot of buying, and it deals with silver and gold and other precious metals in the Northern Hemisphere and in other Americas too, but a lot in the Northern Hemisphere. So that makes it very interesting because, a lot, as we know, a lot of the precious metal plays are in different parts of the world. But the thing, I don't care where it is, it just makes it interesting. What I care about is the buying that's been ongoing in the stock. And as I said, we saw it and talked about it back in September and October. And it has performed very well. And it's one of those things where, as I said, you have to watch where they are in their move, how far they go. But this stock still has plenty of room to run, and we're going to continue to play it as it sets up new buys. And quite frankly, with the pullback it's showing today, it's coming back down around this 20-day moving average. It's been kind of trickling off there. We're going to look for that hold and see if we can get a new break higher. These stocks are a little bit volatile because the dollar fluctuates, and thus they fluctuate as well. But even with the dollar, the dollar was weaker recently, but the dollar's been stronger much of this period, and this stock has continued to move up. So that's kind of a turning point for these stocks that hasn't been there before. And it's showing there's accumulation beyond just what the dollar's impact is on them. And there's a lot of talk about soft landings, or a lot of talk about continuing recession. Inflation is high. There's still a good probability of an ongoing recession. Some of the numbers coming out economically are not great today. There's some terrible stuff coming out. And in that situation, these miners tend to do very well. And that's why the miners have our interest for sure. And we really like McEwen, or as we like to call it, MUX. Okay. Well, let me talk about the service a little bit. As I said, we go through all 4 of those steps, and we do it daily. I mean, this is what I do. We look for these plays. And with the other services, we're constantly looking at all of the stocks in the market, all the ones that are making moves and that we think are going to make moves. We have a big watch list that we put things on, and we distill the data down to the best plays that meet our criteria. This process we're going to come up with many great plays with this, but there's only some that are really, really good plays. And some of our other services, we can put up to 10 plays a week on those. When the fish are running in that good water, we got the line in the water and we're fishing for them. So we're coming up with great plays. And then with the stock of the week, well, we choose the one play that we, as I said, really, really like. It's a double really. And what we'll do is we'll email you the specifics each weekend for that play. We'll go have the chart there. We'll talk about the pattern and talk about why we like it. Again, as Roger said, that's, if you're like that stuff, it's there for you. If you don't care, you don't have to care. So when the entry is met, when it hits our entry point, we like all the conditions there, we'll issue a buy alert. You can get that email, you'll get it by a text alert. And then when it's time to take profits, any action that you need to do, well, we're going to issue an alert at that time as well.
So I just want to reiterate that, on the weekend, you're talking about the setup because you're looking at the charts, but you're waiting for it to hit, act like you were expecting to get the ultimate entry price, and you give that late, whenever it hits sometime during the week.
Right. That's a good point, Roger. It's not that, okay, we like this, go buy it. No, every pattern that shows accumulation, when I say it's probabilities, and you're putting the probabilities in your favor. Something may come along that scuttles everything. Fed says something, China, something happens in China, whatever. And then it upsets the apple cart and everything's got to reset. So yeah, we will send you the alert when it is time to act. Now, that said, what if the apple cart's upset? What if something doesn't work out? Someone downgrades a stock or whatever happens? Well, we keep a few in the back. We have the others, the second and third, that we'll keep around and we'll say, hey, this one didn't work out because XYZ hit, this news hit. So what we want to do is we'll insert that one in. And particularly if it looks really good and like it's going to make the move, we don't want to wait till the next weekend. We want to go ahead and get you a good trade if it's there for the taking. So occasionally you'll get a little bonus bonus of the market overview that we prepare for the other services. It kind of, gets you thinking about what's going on there and how we look at things. And, as I always said, more information helps you be a better trader, whether or not you're picking the entry points or not, just because you understand it. That understanding, it gives you confidence and you act with a confidence, and it just makes you better in everything you do. Now, a little bit of background. The service launched on February 7th. Gosh, what year was that, Roger?
Oh, that was
22. Yeah.
Yeah, just last year. Yep.
Yeah, we've closed 36 positions, 22 of them, 61% winners. And that was while the market was crashing right then. So our annualized gain on the closed positions is 32%. The market lost around 20%. And our open positions are positive. And I tell you, we took a nice 21% gain earlier today on one of the oil stocks that we've been playing. So we believe in what we do because we're looking at these areas. We found these areas when they were firming up. I remember we've done these before, and I've talked about, Halliburton's going to do this and it's going to make us X amount of money, whether it was options or what have you that we were playing. And we saw this setting up back in 2021. They were starting to take off when the techs were starting to fumble. And so our looking at sectors kept us up to date on what areas were gelling, were setting up for upside moves. And we were able to play the oil companies with tremendous success. And lately, it's been a lot of the metals stocks and minerals outside of the precious metals that we've been playing as well with really good success. So it's that looking ahead, that step number 2, wherever we're seeing where they gel, what's coming up, looking at those sectors, not just that are leading, but that could be setting up. And that's how we get these good moves, because we catch them early on. Now, for the service, you get all of this for $23 a quarter. Yeah, you're not getting the summary and the overview and the number of plays. It's $23 a quarter. You're going to get 12 top stock picks for just $23. There's not a better deal in the market out there. So click on the link in the comment section now and order this great deal. It is a fantastic offer. Now, talk about putting probabilities in your favor for $23 a quarter and getting 21% returns on the stocks, on the money that you put in. That's putting probability in your favor. And it doesn't matter what the market's going to be doing. We're going to find those that are going to make you that money.
Yeah, the track record since we launched this, in such a tough year, you're up significantly on your closed positions. You're up, and you take all your open positions. You're up on those too. In a year, I saw the stat the other day, John, in the Wall Street Journal, that there were only 40 mutual funds that were actively managed mutual funds that made money last year. Like anything. So if they made 1%, they were on that list. Only 40.
Wow.
So, and the other thing I want to, mention, John was talking about his other services and how, he does make up to 10, picks in a week and does all this commentary and everything. Those services cost $1,495 a year to get. So you're going to get the best pick from those for only $23 a quarter. So it's a fantastic deal. It's been a really, really popular service. Lots of great feedback from it. One of our best sellers in the last year. So click on the link in the comment section right now to take advantage. As you've been hearing all day, all our offers are, this unbelievable $23 offers. So this one's no exception, only $23 for a quarter, and it just keeps going, only $23 a quarter. It's not like it's going to go up after that. That's what you're going to keep on paying. That's our 2023 kick off the year special. So click that button, that link right in the comment section right now to take advantage of this offer. John, thank you so much for being part of the program today, and we had fun in the roundtable, the panel this morning, and we've been having presentations all day. And everybody stick around. We got one more left. Up next is Bob Carlson, and he's going to talk about the #1 retirement tip for 2023. So we'll be back in just a couple of minutes. Thanks.
Thank you.
All right, welcome back, everybody. I hope you enjoyed John Johnson's session and hope you've enjoyed the entire day. It's been a wonderful day. And now we have Bob Carlson with us, batting cleanup. You get the bat cleanup here today, Bob. So I want to just remind everybody that to subscribe to the YouTube channel, just hit the button right below this video and you'll get content every single week. And we have some more things in plans to do. So make sure you hit that subscribe now button so you don't miss anything. And as I said, we have Bob Carlson here next, and he's going to talk about the #1 retirement tip for 2023. So Bob, take it away.
Thank you, Roger. Good to be here. Thank everyone for joining us. I think I'll just get right into my slides here and make the presentation. Hope everyone can see that now. So we're going to discuss the #1 retirement strategy, investment strategy for 2023. And so first we need a little background here. We have to review what I call the old environment. And I say that because many people are still following the old environment. It's going to cost them money in 2023, just as it cost them money in 2022. You know, in the old environment, which has been pretty much since the early 1990s, inflation was reliably low. It was 2% or less the whole time. So people didn't really need to have to factor inflation into their planning, and that kept interest rates low. And that allowed the Fed to keep putting money into the markets, into the economy. You know, the Fed shifted its policy, so it was basically supporting the stock markets for most of this period, and especially since the end of the financial crisis. So low interest rates, a lot of liquidity, and this really helped stocks, helped stock prices a lot. Profit margins, for a variety of reasons, reached record levels, as did earnings growth during this entire period, and particularly during the last 5 years or so, really record profit margins across the board for many companies. Also, stock valuations went very high. They're still very high, but because of the low interest rates, because of the liquidity, because the Fed was actively supporting stock prices, valuations went up. Investors felt very comfortable paying higher and higher prices for each dollar of earnings. And in fact, if you look at the performance of the stock market over the last couple of decades, it dramatically outperformed economic growth. And that can happen over shorter periods, but it's very unusual over a longer period. And this happened because of these monetary policies, and the overall environment just made it safe for people to pay more for stocks. And most of the return in stocks over this period was due to a combination of the higher valuations that people were willing to pay and the higher profit margins. So the lessons people learned from this period is that risk always pays. Invest for risk, invest for growth. Growth stocks did dramatically better than value stocks over this period, and US stocks did dramatically better than foreign stocks. So people learned always invest for growth, invest for the highest returns out there, and don't worry about the downside risk. And people developed the concept of what they call the Fed put, which basically meant the Fed was going to keep a floor under stock prices, that if they fell a certain percentage, the Fed would step in, increase monetary supply, put more liquidity in the markets, and push stock prices up. So that became the strategy of what's called buy the dips. And that's what many people learned over the last couple of decades. It's what they still think is the appropriate investment strategy. And we saw that in 2022, after stocks fell, people started buying again and staged some bear market rallies. Now, the new environment is very different, and it's really a return to the environment that existed prior to the 1990s. We had this record monetary expansion during the pandemic, where the Fed decided to just provide enough money to the markets and the economy to make up for these parts of the economy that were shut down and people that were out of work. So we had the record monetary expansion, and I'll show you some charts on that in a few minutes. And that eventually led to the highest inflation in 40 years. So for a couple of decades, the Fed was able to put as much money as it wanted to into the economy and into the markets without worrying about inflation, because a number of broad global disinflationary factors kept a lid on inflation pretty much no matter what the Fed was doing. So that came to an end in 2022, and it really started before that. We were seeing inflation creep up higher, but it was a slower pace. but because of the extreme monetary expansion during the pandemic, inflation really shot up in 2022. And so the Fed, while it initially said, this is temporary, it's going to come down, eventually realized that was not the case. It reversed course very quickly and engaged in one of the fastest monetary tightenings ever, certainly the fastest in the last 40 years, where interest rates just went up dramatically beginning last May of 2022. Very unusual period. And so there are certain negative effects of that. Of course, it's a very bad year for financial assets, really most assets, but certainly stocks and bonds in your typical diversified portfolio did very poorly. Treasury bonds had their worst year ever. So across the board declines in financial assets because of this rapid tightening of interest rates. Despite this, the economy remained pretty strong. There were certain sectors that suffered, but for the most part, the economy continued to grow. And in particular, the labor market remained strong. And this is important because the strong labor market is something that's keeping a floor on inflation. It's keeping inflation from falling back to that 2% level or falling back rapidly the way the Fed hoped. And that's because the tight labor market is keeping compensation increases at a rapid rate, higher than they've been for the last 20 years or so. And that's supporting spending and supporting these higher prices and the inflation. So despite this new environment, many investors followed the old playbook where they would buy the dips, just assume inflation was going to come down and that the Fed would come in and support the market. So we had a couple bear market rallies in 2022, and then eventually investors were burned by trying to take advantage of those rallies. What you need to know about this new environment, and this really a return to the old environment, is that when the Fed changes monetary policy, the economy does not respond right away. There are lags between Fed policy changes and the ultimate effects in the economy. And the way this typically works is that the most sensitive financial assets will react first. So when the Fed tightened policy in 2022, we saw bond prices decline rapidly. Also, key sectors of the stock market that depended on liquidity, depended on growth and low interest rates, they also fell. So we saw those big declines in growth stocks, in the more speculative assets, such as the digital currencies and some other things. And then the effects of the policy change start to spread to the economy. And you have liquidity and interest rate sectors, and these react first. We've seen a big change in housing over the last year. Prices have come down in a number of areas, and certainly sales have gone way down because of the higher interest rates and the lack of liquidity. Other sectors that have suffered have been the tech sector that really boomed during the pandemic. You've seen the big layoff announcements in technology companies, and your more speculative and leverage sectors. There was a big boom in companies that really had no revenue or no earnings. Startups, very small companies, they were doing well with the initial public offerings. That's all changed. They've gone down significantly. The stocks that did best during the pandemic are way down, many down 70% or more in price. And so that's the initial effects. And then the rest of the economy begins to respond later. And typically it can take 18 months or longer for the overall economy to really react to more tighter policy from the Fed. And while many people are expecting unemployment to go up and the recession to kick in, really, labor market and inflation are lagging indicators. They're really the last to react to a change in Fed policy. And the Fed really can't relax its tightening policy until the labor market tightens up, because it's that tight labor market and those wage increases that are supporting inflation. So we have to wait for the labor market to get tighter, for those wage gains to slow down, for more people to lose their jobs, unfortunately, before we can see a looser monetary policy coming in. And while many people are looking at the monthly inflation data. The important thing to know is that inflation typically peaks after a recession begins. So we're not, peaks and doesn't really to turn around until after a recession has begun. So many people are looking for this decline in inflation and taking it as a sign that the Fed will change policy. Really, the Fed's probably not going to change policy until we're in a recession, and that's going to soften the labor market and bring inflation down. So you need to pay attention to these lags in policy that are now in effect and not just look for instantaneous responses from the Fed and the markets. And here's some of the charts. Here we have the monetary base. This is the total amount. This is the key sign of how the Fed is changing its policy, how it's implementing its policy. This is a long-term chart. And you can see the base increased at a more rapid rate beginning in the 1990s because that's when the Fed learned it could increase the money supply without having a big influence on inflation because of the broad disinflationary factors that were in place. And then there was that big jump in the monetary base following the financial crisis when the Fed decided it wanted to implement what's called a wealth effect, where it would support the stock markets and the housing markets with liquidity. And that would bleed through to household wealth and make people feel more confident to spend more and help the economy grow. And then around 2015, the Fed tried to reverse some of that policy, reduce the monetary base, but the economy was not strong enough to sustain its growth in the face of that. So it was a brief experiment. Eventually, the Fed returned to some quantitative easing, increasing its base. And then we had the pandemic, where the monetary base really shot up, and that's brought about the inflation we have now. But you've seen that in 2022, the Fed is starting to bring that monetary base down. And here's the same number, but the 12-month rate of change over the last 10 years. And you can see the Fed has really tried to bring that monetary base down, gone into negative numbers over the last year, trying to take liquidity out of the markets and the economy. And so to restrain the inflation and bring it back closer to its 2% target. Another example.
Bob, the volatility on that last chart is just crazy when you put it into just the 12-month. That's a lot of volatility.
Yeah, it's they changed their policy month to month, tweak some things. So you got to look at the broader trend. But yeah, it does fluctuate a lot month to month, and that sometimes explains some short-term changes in the markets as liquidity comes in and out at a rapid rate. So here's another example of the tightening. This is what I mentioned was the most rapid tightening probably in history, certainly in the last 40 years, where we saw the 3-month Treasury yield. You know, the Fed can control short-term rates, has less control over long-term rates. So when we look at this 3-month Treasury yield, we could see it was around 0. And it suddenly shoots up to well over 4% just in a year. So this is a historic rate of tightening, really a shock to the system, but it shows how concerned the Fed became about inflation and how much there's been a serious change in policy versus what was in place before 2022. This is the real interest rate on the 10-year Treasury. Real interest rates are important to follow. This is the difference between inflation and the interest rate, the market interest rate. And it's what really affects investments and business decisions more than nominal interest rates, because the real interest rate is, as the name says, what people are really paying adjusted for inflation, or what they're really earning on any investments they have. And so here you see the real interest rate has actually continued to go up, even as some market nominal interest rates have come down, and that's because of that inflation factor. So as real interest rates go up, that keeps a lid on the stock market, also keeps a lid on economic growth. So better than following the nominal market interest rates that are published on all the websites, it's better to look at the real interest rate, the interest rate adjusted for inflation. And that's where you can really see if the Fed is tightening policy, loosening policy. If the real interest rate keeps going up, that's a sign policy is still tight and the Fed is still trying to take liquidity out of the economy. So people have been looking for stock market bottoms all through 2022, ever since the Fed started tightening. If you followed the markets, you've seen that each time there's some little bit of good economic news, there are a bunch of people saying, well, that means the Fed is going to pivot soon. It's going to stop tightening and begin loosening monetary policy. They really want to find the stock market bottom. But since we're back to a traditional monetary policy, we're also probably back to a traditional bear market in stocks. Stocks typically in a bear market don't go straight down and then bounce straight up. People got kind of used to that type of behavior in recent years because the Fed was supporting stock prices and supporting the economy with a lot of liquidity. But typically that's not the case. And I think we're in this traditional bear market. So we're not going to see these straight lines down and up. And also in the traditional bear market, rallies are quite common. John Hussman of the Hussman Strategic Growth Fund says bear market rallies occur regularly and they can be fast and furious. They get people excited. They think, oh no, I've missed the bottom. The stocks have gone up 10% in the last week or two, perhaps 20% from the bottom. I have to get in. And it's important not to fall for a bear market rally because they'll peak quickly and they'll retrace their path downward very quickly. So you want to be careful that you're not buying into a bear market rally and mistaking it for an overall market bottom in the beginning of a new bull market. Now, there are several services that they'll put on one chart some of the historic classic bear markets, such as 2008, 2000, and even going farther back. And they'll lay on top of that also the markets trends that have happened since the beginning of 2022. And what these charts are showing is that what happened in stocks in 2022 is really very typical of a classic bear market, where stocks go down 20% or more and then they rally. And they can rally, as I said, 10 to 20% from the bottom, but then they begin a new downward trend. And the new downward trend goes farther down than the initial bottom before the bear market rally. And there's also usually more than one bear market rally in a classic bear market. And as I said, these charts show that so far, beginning in 2022, we're following the pattern of a classic bear market that goes down 40% or more from the top. So if we continue with that, if the Fed continues tightening policy to try to squeeze out inflation, then we can be looking at another 20% or more downside in the major stock market indexes. And another important thing to consider when you're looking for the stock market bottom, looking for the end of the bear market, is that in the past, the stock market has not hit a bottom until the Fed changes from tightening to easing. We're currently still in the tightening phase. The Fed's been very clear about that. It's going to continue in the tightening phase. So people who are expecting this bear market to end soon are ignoring history, because we need to have this shift to easy monetary policy. In addition, the shift has to be to easy policy. It's not a shift from tightening to maintaining the current level. The Fed might say it's going to stop tightening at some point, stop easing, stop increasing interest rates. That's not the same as pivoting to easier monetary policy. So the bear market can continue for some time after the Fed stops tightening if it has not started to ease policy. Another sign, as I said, many people are continuing to follow the old playbook in the markets. And one sign of that is we look at what's priced into the markets. We can determine this from looking at futures prices, looking at what people are expecting to happen in the markets, interest rates and inflation, based on their bets in the futures and options markets. And we can also look at corporate earnings estimates from the analysts. The analysts are not expecting much of a recession. It's only in late 2022 that they started to say there might be some decline in earnings over the next year. If there is a recession, which I think the Fed probably needs to trigger to reduce inflation to its target, Earnings are going to come down. They're going to come down more than is projected. So from looking at corporate earnings and looking how stock prices are priced in the futures markets, indicating what earnings will be going forward, people are not expecting much of a decline in earnings. So they're not expecting much of a recession. They're thinking the Fed's going to be able to turn around inflation without damaging the economy or corporate earnings much. Another sign is we're seeing indications in the markets that people don't expect growth to slow much. They expect it to remain positive. Again, it's only recently that some economists and some of the data have said growth might turn negative. There might be a recession sometime in 2023, but if there is one, it's going to be a mild one. Most importantly, the markets are indicating they expect inflation to fall very quickly. They think the tightening the Fed has done is going to bring inflation down to the Fed's target of 2% or so, without much economic damage, without a recession, without much harm to corporate earnings. And they also expect that once that happens, the Fed will shift to easier policy, perhaps as soon as the middle of 2023. So the markets are saying we're going to return to this environment we've had since about 1990, where inflation remains contained, it falls quickly anytime it increases, and the Fed can soon return to injecting liquidity into the markets and the economy and boost stock prices. Now, as I've said, I don't think that's accurate. I think inflation is stickier than the markets are pricing in. And so I think this is a too optimistic scenario, that the bear market has a little farther to go and the Fed has more work to do before inflation comes down. I think inflation is going to get sticky somewhere around the 4% level. And then the Fed's going to have to decide if it's going to accept that level of inflation and avoid a severe recession, or if it's going to get serious about bringing inflation down to that 2% target and perhaps incur some economic damage.
Do you think they'll actually get down to 2%? Because historically, whenever it hits over 7%, which we've seen, it takes years before it gets even down to like 5%.
It does, and that's why I think the markets are too optimistic, and it's really going to depend on what damage or what criticism the Fed's willing to accept. So far in the public comments, all the Fed officials have said they're going to do whatever it takes to bring inflation down to its target. That's easy to say when the economy is growing and the labor market is healthy. It's harder to stick to if inflation falls to, say, 4% and the economy is starting to experience some real damage. So it's really going to depend on how much the Fed officials are willing to stick to their goals and whether any criticism that comes their way and the public damage that occurs from a weakening labor market. So given this scenario, this outlook, I'm recommending for 2023 basically a two-stage investment strategy. In the first stage, I recommend putting money into Hussman Strategic Growth. It's a mutual fund. It has kind of a two-phase investment strategy, a bicameral strategy if you want. They own about 270 stocks. It's about equally invested in each of these stocks. It doesn't weight one more than the other. It's very rare any of these stocks is more than 2% of its portfolio. And these are stocks that are picked because they're good growth, their cash flows increases, but they're trading at reasonable prices based on the manager's models. So first part of the fund is it owns these stocks. Many of them are held for a long time. It does some trading, but it's not a high turnover fund. These tend to be longer term positions. The other part of the fund strategy is it uses futures and options, and it can either hedge the portfolio against a market decline, or it can leverage the portfolio in anticipation of a bull market. So these futures and options can, either protect against the downside, or they can enhance the returns in a good market. And they use a few things to determine these futures and options positions. One is valuations. The manager, John Hussman, uses several valuation measures. He has developed his own valuation measures, one of those. And so this is a longer term tool. Valuations, he says, are not a good predictor of short term or even intermediate term returns in the markets, but they're a very good predictor of returns over the next 10 years based on his research. So he looks at these valuation measures as one step. And he's been saying consistently that even though valuations have come down in 2022 and early 2023, they're still very high by historic standards. They're even right around the level of the 2000 tech bubble. So still very high valuations. And also those valuations assume that current earnings growth and profit margins remain at current levels and that they're not hurt by a recession or even slower economic growth. So leg number one is very high valuation. So that's a negative for the market. Then for the shorter term, he looks at a series of measures he calls market internals. And these basically measure how speculative investors are willing to get. As you know, there are periods when valuations get high, but they continue to get higher because there's liquidity in the markets. Investors are feeling speculative, they're in a good mood. So they will push prices still higher. So he looks at the market internals for shorter term direction on these futures and options positions. And currently, recently, he's been saying through much of 2022 and into 2023 that the market internals are not good. They're not uniformly negative, but they're not positive. People are not in a speculative mood for the most part. So they're not going to push prices higher the way they did, for example, in 2020. So given the negative valuations, the negative market internals, he's pretty much fully hedged against a market decline. So what this means is that when the stock market indexes go down, Hussman strategic growth goes up in value. It's had a double-digit return over the last 12 months. So that's one sign of how this strategy works. In a shorter term, if the market goes up, this fund might go down or might hold its value. But when the indexes go down significantly in a bear market or a sharp correction, this fund will go up in value. But what's nice about this is, as opposed to buying a fund that's just going to sell short the market all the time, is if things change, the fund can change its strategy. If the Fed decides to change policies, if investors become more speculative, if there's more liquidity in the markets, then the hedge against a market decline can be reduced or relaxed. So it kind of gives you a very flexible way to take advantage of the current market environment. If there's a resumption of the bear market, as I expect, the fund will go up in value. It will have a double-digit return. If the market's flat, then this fund will probably be flat as well. But if the market internals change in a favorable way, then the hedges can be relaxed and we might participate in the market recovery. So that's stage one. And that's what I suggest you keep in place until it's apparent that the Fed is going to reverse policy and go into an easing.
All right, now, I know this is the last part. You're almost at the end. We've got just a couple minutes left.
Okay. So once the inflation's come down, once it's apparent the Fed is going to change policy, then you want to get into some kind of leveraged fund that's going to do well as interest rates decline. One is the iShares long-term bond fund with the ticker TLT. This lost 30% in 2022 as interest rates went up. It'll have a similar return as interest rates go down. Or you could look at some even more aggressive speculative funds. These would be closed-end funds that invest in fixed income securities. The ones I've listed here invest in preferred stocks, preferred securities, but they also use leverage. They use about 30% leverage. So it's going to enhance the returns as interest rates come down, perhaps even more than TLT. So if you're willing to take more risk, be more speculative, once the Fed changes policies, switch into one of these closed-end funds and you'll do well. So that's the two-stage strategy for now. Get into Hussman strategic growth. Once it's apparent inflation is going to come down and the Fed's going to switch policies, then go into one of these leverage strategies that's going to benefit from lower interest rates and steadily falling interest rates. So Rogers, as you know, we're offering a special subscription to people who are watching this virtual conference. We typically charge $249 for 12 months of retirement watch. We're going to offer to our viewers $23 per quarter. And with that, you get our 12 monthly issues. You get full access to the subscriber section of the website, which has a lot of material on it. You get a wide range of bonus reports and books in PDF format. So it's really a very attractive offer. You'll be able to keep up to date on where I think we are with the markets, the economy, and the Fed tightening. And you also get our advice on the full range of retirement financial issues, estate planning, annuities, Medicare, Social Security, long-term care insurance, the whole package of issues you need to consider as part of your retirement planning. So Roger, that is my advice and presentation for people.
All right. Well, yeah, thank you, Bob. And I think one of the things that, is great about Retirement Watch and different than most newsletters out there is, as Bob just said, it's not just the financial advice, but it's all the retirement planning. And he goes through all the new rules, the new updates, the new laws that have been passed, keeps you up to date, because you can't just do it once and let it sit, because things change and you need to change your estate planning around what has been changing in the laws. And Bob keeps you up to date on that. So as everybody knows, if you've been watching all day today, we have these $23 great offers. So $23 per quarter. You can click the link that's in the chat box right now to subscribe to Retirement Watch for only $23 a quarter. It's for new subscribers only. A great price, great way to try it out, only 23 bucks a quarter. So click that button right now. Well, Bob, thank you so much for joining us today. And everybody, it's been a fantastic full day of presentations. I hope you enjoyed them all. And again, subscribe to Retirement Watch by clicking that link in the chat box right now. Subscribe to the YouTube channel by clicking the subscribe now button below. And again, if you missed anything today, this will be on our YouTube channel, so you could go back and watch the whole thing, and we'll have it broken out so you can watch presentation by presentation. So if you missed anything today, come back and see the other ones that you missed. And that will wrap up our full, very busy day. I hope everybody enjoyed it, and I wish everyone a very profitable day. Thank you.